Yesterday was a small day. It was a reversal day. We rallied a couple legs up and then a midday reversal for 38. And we're gapping down today. And the market is simply waiting for tomorrow's FOMC announcement. Everybody expects the Fed to raise rates a quarter point and then maybe change the wording and say that they're going to pause for several months. We'll see. I think what's going on is, this is the weekly chart. We've been sideways now for a year and a half, and we're getting higher lows and lower highs. But I think this is the key price up here in August. We had an exceptionally strong rally in August, and the bulls who bought up here did not become disappointed until here. And once they were disappointed, they never had a chance to get out break even. And when that happens, you'll have bulls looking to add on lower if they get a pretty good looking buy signal bar, which they got here. So if they bought up here and bought more here, there's an 80% chance it's going to go to the midpoint of their two buys, which happened here. So they could have exited here. There's a 60% chance it'll go all the way up there. I still think we're going to go all the way up there, but I also think that we'll have a hard time going much higher. And right here, we have an expanding triangle on the daily chart. We have a high, a higher high, a higher high, and we have a lower low. And we have a head and shoulders top, left shoulder, head, and right shoulder. The bears would like a break below the neckline down here, and then a break below the October low. I do think we're going to go below the October low, but I think it's more likely that we're going to go up to the August high first. And then we'll have a big double top and then break below here and go down to my target, which is based on that 4,000 gap on the daily, weekly, and monthly charts. Here's the weekly chart. This green line is 4,000. There was a gap up over here, and we've been oscillating around it for a year and a half, a lot of bars, 50, 60 bars. So it's clearly an important price. This is important, and two important prices often generate a third important price, so a measured move down, which is below the pre-pandemic high. And I think that's where we're going. It's right around 3,200. Now, right now we have a lower high double top here, break below the neckline, and it gets us in this area. We have a double top here. Here's the head, break below that, gets us down there. I think this is where we're headed. The market's simply deciding whether it's going up here first, or if this head and shoulders top will get us down there. We had a very extreme rally. You expect a couple legs down, and we've had many legs down. I think that this whole thing is going to turn out to be a first leg down, and this is the pullback from the first leg, and then I think we'll get a second leg down. Now, there are different reasons why we could have a second leg down. I think the second leg down will be pretty fast, and the different reasons for that. First of all, we're in a triangle, so the reversals are coming faster, so there's more agitation, and when you break out of an area of uncertainty that has lasted a long time, you often quickly move for about a measured move, maybe based upon the height of the triangle, which would take us somewhere down here. So I think we'll get a quick move down at some point, and an obvious catalyst would be the failure to resolve the budget problem, and that could come as soon as June. There could be something in Ukraine, there could be something in China, and there could be something totally unpredictable. For example, there could be some big problem with offices, office rent, and buildings, and more loans on offices, and then banks having a huge financial crisis. So one of those things will be what people will point to as the cause of the sell-off if we get the sell-off. This is the 60-minute moving average. We have a gap down it's not a very big gap. It looks big, but it's not actually very big in terms of points. We have a big bear bar closing near its low. And do you want to sell a big bear bar closing near its low when it's closing at the 60-minute moving average and with a big tail below? Most traders will not take that short. This is what we have. We have a very strong rally over the past several days. This was an extremely strong rally. I suspect we may come back down and test here the first big pullback. I don't know that we'll get there today. The market might wait until tomorrow's FOMC to get there, but that would be a reasonable thing to do, to test here or test here either today or tomorrow. A head and shoulders top, left shoulder, head and right shoulder. Measure move down gets us to this general area. Now, 60-minute chart, that is a really steep rally that has lasted for a lot of hours. It's unlikely the market is going to go straight up and straight down without first going sideways. So this is probably part of a trading range and not the start of a bear trend. It is possible that with tomorrow's FOMC we just collapse, but I don't think so. The Fed is probably not going to do anything that is terribly unpredictable. Powell, as you know, since 2018, I've been extremely critical of Powell. One good thing he has done is he has not surprised anybody. He's been pretty good at telling everyone what he intends to do. So I do not expect a big surprise tomorrow with the FOMC report. Now, if you're going to be shorting far below the average price, you want the price action to be far above average bearishness. And bar 1 is a pretty good bear bar, but it has a prominent tail, and that's not ideal. One of my general rules on the open is if the first bar is a bear bar and it's not bearish enough, or if the context is not good enough, I want to see consecutive bear bars with at least one being big and closing near its low, and then sell the close or sell below the low of the bar. So if 2 closes on its low, that would be a credible sell. Yesterday, if you did not buy above 1, you could buy above 2. Didn't go up very far, but that would be what you could where you would buy. Here we're right at the 60-minute moving average in a strong bear trend. You can say, well, Al, that's about 20 bars above the moving average. Isn't that a 20 gap bar buy? A gap between the moving average and that low, a gap between the moving average and that low. We've had about 20 bars where there are gaps between the low of the bar and the moving average. So bulls were willing to pay an above average price for a long time. Now they finally get to buy at the above average, buy at the average price. And there will be a lot of bulls buying at the average price. So I think the odds of this being a big bear trend day are not very big, at least not yet. I say that, but if we get 2 big bear bars and they close on the lows, and then 3 big bear bars, it could end up as a big bear trend day. We broke out below the Globex low right on the open. Here's the Globex low, hard to see. Broke below it on the open. And Globex high is not all that far up. It's only about 20 points above where we are. So it's possible we could get a reversal and get above the Globex high. On the open, you look at this and say, wow, this is really bearish. But on the open, no matter how bearish or bullish anything is, you should assume there's a 50% chance it's simply a test of support or resistance, and the market will go the opposite way. So this close of bar 2 is important. If 2 closes on its low, you'll have more traders willing to short down here. If 2 does not close on its low, that increases the chances we're going up to the moving average, which is above yesterday's low. Right now it's above yesterday's low. If we just go sideways here for 4 or 5 bars, the moving average will be below yesterday's low, and then we could get there without closing the gap. All right. So if you're a bear, you see 2 big bear bars, you say, wow, that's bearish, that's good. Yeah, it is, but big tail, and 60-minute moving average. That's bad. So, now if you're a bear, you're saying, well, that's really not what I want to see if I'm going to be selling relatively far below the average price. So, is it always in short? Yeah, it's probably always in short. Do I think we're going a lot lower? I don't know. I need more information. And if I need more information, I'm not willing to sell far below the average price. You know, if I need more information, that means I'm confused, and that's my radar picks up that confusion and concludes that we're probably going to have some kind of a trading range early on. But it'll change if we get a big bear bar closing on its low. Then this could become very bearish, and it could end up as a big bear trend day. With tomorrow's FOMC, every FOMC report is important, and they're more important during times when the Fed is changing what it's doing. And the Fed has been changing what it's been doing over the past many months. Instead of raising interest rates 3/4 of a point, it's been raising interest rates now 1/4 of a point. And if they are able to slow inflation, they probably will end up significantly slowing the economy, and they'll have to cut interest rates to stimulate the economy. So at some point in the next year, maybe in the next 6 months, the Fed will end up cutting interest rates because they'll be satisfied with inflation, but they'll be worried about unemployment. The Fed was created to do two things: to keep inflation low and to maximize employment, keep people in their jobs. So you want them to be working, and you don't want them to, and you want to make sure they have enough money to buy basic things, food, shelter. So you don't want inflation to be going up, because when inflation goes up, it usually goes up faster than wages, and that makes people relatively poor. And the problem with the Fed is their two goals, low inflation and low unemployment, are kind of opposite. So to keep inflation low, they have to raise rates, and that tends to make people lose jobs. You know, companies have to cut back. Okay, so we have two bear bars, but neither one is quite good enough to attract a lot of sellers. The bears are going to try to get a third consecutive bear bar. And if they get a third bear bar, especially one closing below its midpoint, you will start to get traders who will sell down here. I don't like the two big tails, and I don't like the market pulling back to a rising 60-minute moving average. So I'm probably not going to short below 3. So far, 3 is an inside bar. If it closes on its low and does not fall below 2, that would be a reasonable swing short. Traders looking for a bear trend from the open. Sometimes you get these bear trends from the open where you have bear bars that just don't look bearish enough, yet the day ends up as a huge bear day. Now, I said this is not bearish enough, right? Not yet. And I said 50% chance it's a bear trap and that we're going to reverse. What do traders need to see to conclude we're going to reverse? They need to see something bullish. They need to see a bull bar, especially a bull bar with a decent sized body and a bull bar closing near its high. We're right at the 60-minute moving average. So a lot of the bulls will want the bull bar to close on its high and close at or above the 60-minute moving average. And if they get that, you will get buyers above 3 looking for the market to go up and test yesterday's low. At the moment, I think we're going to close the gap. But if we start to get big bear bars closing on their lows, then this will end up as the high of the day and will go down. Okay. Now, is 3 going to close on its low? If it does, traders will short below. Is 3 going to close on its high? Okay. Is 3 going to close on its high and close above the moving average? Then traders will buy above 3. it did neither, right? So it's not good enough for the bulls. It's not good enough for the bears. So what do? You wait. Now, since it's not good enough for the bears, can you buy below 3, buy below 2? I would not. I don't like to buy until on the open. I don't like to buy until I start to see some bull bars. But I think we're going above yesterday's low. But I'm not willing to buy above 3. Bears are hoping that the gap down and bear trend from the open continues all day. They're hoping for this. Okay, 20% of the time, if you get a gap down and a bear trend from the open, it'll last all day. Okay, 20% of the time, it'll go down and reverse, and 60% of the time, it'll go down and stop going down, entering a trading range. When I say bear trend from the open, I mean more than 3 bars. So if it lasts for an hour or so, then 20% it'll last all day, 20% will reverse, and 60% will do that. Right now we're still deciding if it is a bear trend from the open or if it's simply a bear trap, a quick sell-off down to the 60-minute moving average, and then a reversal up into a bull trend. Sometimes you get a bear trend from the open, a trading range, and trend resumption down. Other times you get a bear trend from the open, a trading range, trend reversal up. And sometimes the bear trend from the open doesn't look, it looks kind of disappointing. You get bull bars and tails, yet it can last all day. And what you want to see is a pair of bear bars, one being big, closing on its low. And at that point, you conclude the market is sell to close. Here we got 4 bear bars in the first 5 bars, none all that bearish. Here we have 2 consecutive bear bars, one being big and closing on its low. In this case, it's the first one. Here we have the same thing. So this is sell to close, and it's looking good for the bears. 3 bear bars, 2 with tails. We ended up going sideways for several hours and then down. Here, 2 big bear bars, one being big, closing on its low. It's sell the market, sell with a stop below, and we ended up going down pretty far. So far, we have none of that. So far, there's still a 50% chance that we're not going to go a lot lower. We may go a little bit lower, but 50% chance we're not going much lower. That this is just a bear trap. A quick sell-off down to support the 60-minute moving average, and then a reversal up from that support. Daily chart did that over here. Big sell-off down to the 50-day moving average, and then reversed up to the 50-day moving average. Weekly chart, a big sell-off down to the 20-week moving average, and a reversal up. To buy above 4, the bulls will want the bar to close on or near its high. To sell below 4, the bears will want 4 to close on or near its low. 3 is an inside bar, a low above 2, a high below the high of 2. And 4 is a second consecutive inside bar. So right now we have an II. If it remains in the II, it's a breakout move pattern. If it's a bear bar, I think most traders will not take the buy, even though it's an II and a sell climax. If 4 closes near its low, you will get traders taking the short below 4. An II is a breakout move pattern. 50% chance you get a successful bear breakout, a swing down. 50% chance you get a successful bull breakout and a swing up. 50% chance the first breakout up or down will fail and you'll get a reversal. All right, so this is, you'll start to get bears willing to sell below 4. I'm not going to sell below 4. The first 4 bars all have tails, which is not quite bearish enough. And we do not yet have consecutive bear bars with one being big and closing near its low. And I'm not buying above 4, even though it could be the low of the day. It's an II and a sell climax. So right now I'm stuck on the sideline. Gap down and a sell climax. If the sell-off on the open is just a bar or two like this, I call it a bear trap. But if it's 3, 4, 5 bars, I call it a sell climax. And either one could lead to a reversal. So a sell climax and a reversal up, a bear trap and a reversal up. And big collapse. You could buy above the bull doji or wait for a second bull bar and then buy. And here, well, we have an outside bar, and the buy is probably here or here for most traders. Big sell-off on the open, and then a bull bar. Some bulls will take the first buy, some will wait for 2 or 3 bull bars. And if you do get a big sell climax on the open, lasting 4 or 5 bars and covering a lot of points, and you get the reversal, very often you'll be in a bull channel for the remainder of the day, and you'll get all the way back up near the open. Usually, if it goes up all day, it has a hard time going much above that. So sometimes it'll go a little bit above, but usually not much above. All right. A sell climax on the open and consecutive inside bars, an II. And we rallied. It's a bear bar, but we have a bull bar here. Some traders would buy above the bear bar, some would buy above the bull bar, some would wait for this and then buy above that. And an example of a big sell-off on the open, and the market rallied for the remainder of the day. And the point here is we have an II. And today we have an II. We're getting the bear breakout. 50% chance the breakout will lead to a swing down. 50% chance it'll fail and we will reverse up. I think it's better than a 50% chance it's going to fail. You know, we're not that far below yesterday's low. We're still holding at the 60-minute moving average, and every bar today has a prominent tail below. We have a micro double bottom, down on 2, up on 2, down on 5, up on 5. The neckline of the micro double bottom is the highest point in between, which is the high of 4 or the high of 3, same price. And the bulls want to get above the neckline and then get a measure move up. If they get a measure move up, they'll probably have a couple decent bull bars, and traders will start to buy. I didn't check to see if there was a report at 7 o'clock today, and sometimes there's a report at 7 o'clock. Right now, it's always in short. It's sell to close, but I am flat. It's just not bearish enough to be for me to be selling at the low. What happens if 5 is a bull bar? Do you buy above it? It depends. If it's a big bull bar closing near its high, traders will buy above it. If it's not a big bull bar closing near its high, a lot of traders will wait for one more bar. Some might buy on a stop above 4, the neckline of the double bottom 2-5. But in general, on the open, I don't want to buy until I see at least one bull bar, and I don't want to sell until I see at least one bear bar. And so far, every bar today is bearish, but not bearish enough for me to sell at the low of the day. In strong bear trends, traders will sell at the market. They'll sell at the low. In weak bear trends, traders want to sell pullbacks. So they want to sell above the low. And the opposite is true with bull trends. Okay, so we got 5 consecutive bear bars, but each has a big tail. And how far have we fallen since the close of one? You know, the size of a scalp. So it's not all that bearish. Okay, that closes at 71.75. It has to fall to, the bears have not even made 5 points yet if they sold the close of R1. It has to fall 22 ticks. Needs one more tick. So if you sold the close of 1, you have not even made a scalp yet. So that is not very bearish. Okay. The bears were finally able to make 5 points if they sold the close of 1. It fell 22 ticks. Bears are trying to get a gap. A gap means a bear bar closing near its low, and a close below the low of the prior bar. So the bears want 6 to close on its low, and they want 6 to close below the low of 5. If they get that, traders will start to think that we may fall for a measured move down. And the bulls obviously want the gap to quickly close and for the market to reverse up. But even though things are not very bearish, they're bad for the bulls because most bulls don't want to buy until they see at least 1 or 2 bull bars. And here we are on the 6th bar, and we don't have a single bull bar yet. Also, we're in a bear microchannel. The high of every bar is either at or below the high of the prior bar. So that, again, is selling pressure. And that will make the bulls even more hesitant to buy the first reversal up. II, potential final bear flag. So if we do get a bull bar 6 closing on its high, you'll get some traders buying. As I said, there's often a report or an announcement at 7 o'clock. So right after the close of bar 6, and it can make buying or selling on at the start of 7 difficult because 6 often changes its appearance dramatically in the final second. So it can go from a bear bar to a big bull bar, or it can go from a small bear bar into a big bear bar. And then you have very little time to decide what to do once the bar closes. 60-minute chart. We still have a lot of time remaining in the bar, but right now we're reversing down and we're falling below the 60-minute moving average. But the bar has not yet closed. If it closes back in the middle of the bar 30 minutes from now, it'll have a big tail on the bottom. Traders who are short right here, I think right now they would need their stop above 1. So you're risking, about 12 points or so. And so far that it's just not bearish enough for me. The bears who sold the close of 1 have only made 5 points, and right now they're currently risking 12 points. I always talk about how traders should swing trade, and a swing trade for me means an hour or two, at least a couple legs, and 40% of an average day's range. And the average day range is about 50 points, so 40% is 20 points. And 90% of days you'll get at least one decent swing trade up or down coming from a good signal bar. And yesterday the bulls tried to get a bull trend from the open and did not get 20 points. And then the bears had an expanding triangle top up here with a good sell signal bar. And this was interesting, a double top. So 46 did not go above 43. So you're wondering, is this going to be an exhaustive buy climax and reversal down from an expanding top, especially in an overbought market ahead of the FOMC on Wednesday? Then we got a lower high here, and another lower high here. So it's becoming increasingly bearish. Anyway, if you sold below that low, you also did not make 20 points. So you had 2 of those Walmart type of trades, buying above 1, go to Walmart, come back in a couple hours and see what you get. And then selling below here, go to Walmart, come back in a couple of hours. You can see we're breaking above 6, but I don't want to buy. We've got 6 bear bars. Show me some bull bars. I don't want to be the first bull. I'll be the second bull or the third bull, but I'm not going to be the first bull. Bears are panicking. They see 6 bear bars, but the price has not fallen very much. And they're also aware that we're pulling back to the 60-minute moving average. So you got some bears buying back their shorts. This is not bulls buying 7 going above 6, because bulls don't want to buy. But it could be, I think 7 going above 6 is disappointed bears buying back some of their shorts. Now, the first time it goes, you have a 6-bar bear market channel, and typically the first time a bar goes above the high of the prior bar, there'll be more sellers than buyers. So right now there probably are more sellers than buyers above 6. So you had some bears that took profits, and that made 7 go above 6, but other bears just reflexively sold it. relentless selling for 6 bars, we probably will go lower. The more bear bars we get, the more bears will be willing to short, sell the market, sell the close, sell below the low of the prior bar, and the more bulls will wait for at least 1 or 2 bull bars before buying, trying to get a breakout. 2 went below 1, so theoretically it broke out, but I don't use the term breakout unless you get a close below the prior bar and a close near the low of the bar. So 7 is trying to break out below 6. The bears want 7 to close near its low and below 6. And if it does, traders will start looking for a measured move down. Maybe a measured move below this attempt at a wedge that would get us here. Maybe a measured move from the high of the day to what the bulls were hoping was a bottom. So that would get us down here. And the bears are trying to, I said how I defined the breakout. A close below the low of the prior bar and the bar closing near its low. Bears are trying to get 7 to be a good breakout bar. They want traders to look at that and say, yeah, this bearish. And the bulls don't want that. So you'll have some bulls buying in here, trying to prevent 7 from closing below 6, trying to prevent 7 from closing near its low. And then once you get the breakout, let's say 7 does close on its low and below 6. It's sell the close, sell below. Some traders will still wait for a follow-through bar because about 50% of breakouts fail. And the probability of success goes up if you get a bear follow-through bar. What happens if 7 closes at the 6 low or 1 tick below the 6 low? It's still a problem. Then we'll have 7 bear bars, but each one of them having a prominent tail below. That reduces the chances that the sell-off will last all day. The bears need to start to get bars closing on their lows. Having a bunch of bear bars is nice, but it's usually not enough to get a trend to continue all day. If 7 closes within a point or so of its low, it's sell the market, sell the close, sell below the low of 7. But your stop would be, so that's a reasonable sell. Right now your stop is above 7, above the high of 7. And you're also concerned that the bars are not all that big. We have not fallen all that far. So we still could reverse up. If 8 is a bull bar, especially a bull bar closing near its high, bears will exit. They won't wait for the shot to get hit. 8 is important. Will it be a second consecutive big bear bar closing near its low? That would increase the chances of a bear trend lasting all day. Or will there be something wrong with it? Will it be a bull bar? Will it be a big bull bar? If you do sell here, I would trade small because it's just not all that bearish. We're still down only not even 20 points from the high, and we're 8 bars into the day. So it's not all that bearish. So if you short here, trade small, 20% of your normal position. If you normally trade 1 E-mini, I would trade 2 micro E-minis, sell 2 micro E-minis. If you normally trade 4 or 5 micro E-minis, I would sell 1. The bears have not yet done enough to make me think this is going to last all day. If 8 closes on its low, that would be very good for the bears. Then we'll have consecutive bear bars closing near their lows with 1 or both having good-sized bear bodies. So a bear surprise usually leads to at least 2 legs down, so traders will sell the first reversal up. Can it be the opposite of yesterday, 37.38? We had a bull channel and a bull breakout above the bull channel. We have consecutive decent bull bars, and the breakout failed, and there's a second leg sideways here or here, but not up. I'm going to turn this into pink I usually highlight gaps on the 5-minute chart with magenta, pink. So bears, they trade small, they sell the close of 7, below 7, and then if 8 closes on a slow, they can sell a little bit more. And the bulls, we've had 8 bars today and not a single bull bar. And I usually don't want to buy the first bull bar if we've had a whole bunch of bear bars. We had something like that several weeks ago. I'm probably not going to be able to find it, so long ago. But we had a whole bunch of bear bars on the open. We got a reversal, but it was not the first reversal. Traders want to see more than one bull bar before they they're willing to buy. And I'm probably not going to be able to find it. Yeah, did not see it. Can you buy with a limit order at the measured move? Nope. 8 consecutive bear bars. I think all you do is sell, and you sell small, and you wait until we see at least 1 or 2 bull bars before buying. You can buy 1 bull bar if it's a really big bull bar closing on its high, betting that this is a bear trap. But in general, you don't want to buy if only 10% of the bars are bull bars. For the bears who are trading small, so that's another sell, either on the close of 8 or below 8. The bears who are selling down here, they'll be pretty quick to get out. I would get out above a bull bar, closing above its midpoint. Right now, the stop of the bears is above 7. If it goes above 7, I get out. You could also get out the size of a scalp above the high of the prior bar, so you could get out 5 points above 8, but that's almost the same as getting out above 7. Bulls are hoping that we're doing this. A bunch of bear bars, and then the selling stops, and we go up for the rest of the day. A bunch of bear bars, and then the selling stops, and we go up for the rest of the day. A lot of bear bars, and this is an example here. We got 7 bear bars, and traders did not buy the first reversal up, but they were willing to buy the second reversal up. Here's the II. A bunch of bear bars, but a really good bull bar. Traders will start to buy that. Here, a bunch of bear bars. We got a second leg sideways, not down. We tested this close, did not quite get there, and reversed up a second time. And then we rallied for the remainder of the day. So this is the kind of day when you got to be thinking we may just stop going down, transition to sideways, and then go the other way. Okay, we're well past the measured move. I'm going to erase that. Still sell the close, sell the market. Nothing to buy. Is today going to be a huge bear trend day? A couple of reasons why I think it's probably not going to go a lot lower. First, at the FOMC tomorrow, the market is probably just trying to give back some of the bullishness we've had for the past couple of days. Remember, I said this was exceptionally strong, and we may have to come down to 1 or 2 of these lows. Well, look where we are. We're down at that one. We may come down to this one, and if we get there, I think we're near the area where the market will stop going down. So we're below that, but not below this. I think somewhere in here we'll stop going down. Somewhere not much below where we are. And what happens if we stop going down? What do we do instead? Well, you can reverse up, but this is so bearish at this point that it's unlikely we're going to get a big bull trend reversal. So if it's not going to become a big bull trend and the big bear trend is not going to go a lot lower, what we're left with is a trading range. So this. So probably pretty soon we'll start to do this for several hours. Testing that one low, testing this low, and back all the way back to the March high. It's still sell the close, sell the market. So, if you sold below 7, you sold a little bit more below 8, you sell a little bit more 9, and then you get out above the bull bar closing above its high, or you get out the size of a scalp above any bar, including above a bear bar. Now, if what I said is right, that we're just going down, testing a support area, and then we'll stop going down, and you start to scale into longs. Now, as I said, when you have this many consecutive bear bars, you don't buy the first reversal up. You wait for a second reversal up before you think about buying. So when you have a bunch of bear bars like that, here you have an exceptional bull bar, you might buy it for a scalp, but most traders are better off waiting for some kind of a double bottom. In this case, it's a higher low, but it could be a lower low. A bull bar and then a second leg down. Here we got a big spike and then a wedge channel and a midday reversal up. A lot of times the market will do something today either similar to what it did yesterday or the opposite of what it did yesterday. And yesterday we had a midday reversal, middle of the day, reversal down. So it's possible we can get a reversal up middle of the day. If we were to reverse up, one of the targets is the top of the sell climax here. Another would be the 60-minute moving average. We're getting late in the first hour, and I said it's unlikely that a trend that looks like this is going to collapse into a big bear trend. That still is true, and we're starting to collapse. So we're probably not going to collapse into a big bear trend. We're probably going to collapse down to a support level and then go sideways or bounce. So we're in a zone where the market is probably going to stop going down, near the bottom of this big buy climax bar, 60-minute chart. Can we do the opposite of this? I think it's a small chance. Right now, I would say maybe 30% chance this is just going to keep going down in a series of bear bars all day. On the monthly chart, I want to make a point. Back in August, we had a bull bar, and then a bear, and bull, and bear, and bull, and bear, 2 bears, bull, bear, bull. You can see we've been alternating. So bear, bull, bear, bull, bear, bull, right? But then we had 2 bull bars here, right? March and April, right? The bulls are hoping we get a 3rd and a 4th bull bar, and that we're going to begin a bull trend, a resumption of this trend. But for the past year and a half, we've been alternating every bar or 2. We've had 2 bull bars. We had 2 bull bars here. What do we get next? A bear bar. We have 2 bull bars here. We may get a bear bar. And not only that, what else do you see about last month, April? It's small. Okay? And when you see small bars, there's an increased chance that the next month will be an outside bar. So we may form an outside down bar in May. We went above the April high, and the April low is not far below. So right now, you got to be wondering, are we going to go below the April low? And if we do, we don't have to stay there. We can go back up to the May high. Sometimes it'll go outside down and then reverse back up and go outside up in the same month, kind of like this. So a big down and then back up. I don't know if that's outside up and outside down, but it's that kind of a thing. But the April low is a magnet low. Can you buy above 10? I would not get long above 10, but for the bears, we're probably not going a lot lower. Rather than this being a spike down and the sort of a huge bear trend, spike and channel bear trend, I think it's more of a spike down, a sell climax, a sell vacuum down to support, and then we just stop going down and enter a trading range. When you have big bear trends on the open. I talked about it earlier. I said 20% they last all day, 20% they reverse, and 60% they transition into a trading range. This is what is most likely going to happen, some kind of a trading range. Here we sold off and then trading range second half of the day. Here, a big sell-off like today, you got a second leg down, third leg down, but it stopped going down and sideways the rest of the day. So this is what today's probably going to look like. Okay, low 1. Would I sell again below 10 if you've been scaling in, below 7, below 8? I would not. We're at a key price, so I would stop selling. This is falling too far too fast, so I think we're probably going to get some profit taking soon. If you're a bear and you sold below 7, below 8, you're thinking, wow, I made a lot of money pretty quickly. And now my stop is way up here. I'm risking a lot. There's probably not a lot left over the next several bars. I'm going to start taking profits. So you're going to probably start getting some profit taking from the bears. So I don't want to be selling at a price where a lot of the bears are going to say, wow, what a great opportunity to take profits, and then look to sell again on a bounce. Continuing to collapse, but I think we're probably going to stop going down within the next few bars. They bought here, we're below both of those prices. We're near a 50% retracement of this. Okay, so if I'm a bear, I'm going to be beginning to take profits and look to sell again higher. And if I'm a bull, I'm probably going to wait for a second reversal up before buying. This is the parabolic wedge. Not really. It's more of a, leg 1 and then leg 2 and leg 3. Maybe some computers will see it as a parabolic wedge. Does it sell the market, sell the close? It still is. It's a sell below 10, but I did not take that one. I'm going to wait for a bounce and then look to sell. And to buy, it's really unusual to have 11 consecutive bear bars right from the first bar of the day. It's extreme selling. It reduces the chances today will be a big bull trend day. So right now, what are the chances we'll reverse and go far above the high of the day? Maybe 10% chance. What are the chances that we'll reverse and get up even in this area? 20% chance. So if we reverse, it's more likely it'll be a bull leg in a trading range, and we'll just go sideways for the remainder of the day. Can you buy the close here? If I'm still short, I personally would be exiting part here, if not all here. We have a sell climax, and we have a second sell climax, and we're below the support zone. So I think you're going to run out of bears willing to sell at this price. So if you're shorting, or if you're holding short, you need somebody else to short. And there ain't going to be a lot of people willing to short down here. So it's a good opportunity to take profits on your shorts. So if you sold below 7, you got 20 points. Take your 20 points. What happens if we get 5 more big bear bars? That would be extremely unusual. And I'm willing to not hold short betting on something extremely unusual. Extremely unusual means it's probably not going to happen. What's going to happen is this. We'll get a bull bar. The first time up probably won't go very far. And then we'll get more bull bars and we'll transition into a trading range. It could be a trading range down here, or it could go quite a bit up. But I think we're putting in the low of the day soon. It's possible we can get a little bit lower later in the day, but right now, I do not think we're going to go a lot lower. I think this is too far, too fast, and down to a support zone, a 50% retracement, and at those prior lows during that big rally. It was the first pullback in that huge rally. I have a buddy, one of my tennis buddies. It's funny. He's familiar with all my stuff. And last year, he said he just trades spider options, and he day trades. And he told me last week, Al, I made $350,000 on trading spider options last year. But some of the things he does are just really dumb. The market, like on a day like this, we played tennis that night. He said, Al, I've been I've been buying put options. And I told him, you're way too early. But, whatever he's doing, and he scales in as it goes up. So, whatever he's doing, it's profitable. All right, so inside bar 12, we're at the end of the first hour. And the first hour looks like it's going to close near its low. And when you have a big bear bar on the 60-minute chart, the market usually tries to go below the low of that bar in the next hour. So bar 13 or 14 probably will go below the low of the hour. But if it does, it'll start to look more like a parabolic wedge bottom. I'm flat. I'm not willing to sell down here. I'll look to sell a rally. This is the sell. That's the sell. And then, to me, this area is a good place to buy back shorts, betting against it falling a lot further from here. The odds are it's not going to fall a lot further from here. The odds are it's going to stop going down and either start to go up or simply enter a trading range. And if it does go up, this selling is so relentless and so extreme, chances are whatever rally we get will lead to a trading range and not a big bull trend. So 90% chance we've seen the high of the day, and traders are looking for the low of the day. You can see profit taking. Is this bulls buying or is it bears buying? It's bears. It's bears buying back shorts. They don't want to risk all the way up here, and they know there probably will not be a lot of new sellers down here, so the bears are starting to take some profits. That's the end of the hour. The hour is a huge bear bar closing near its low. We might go below it, but I think we're probably not going to go much below it. A 50% retracement of that big rally and testing these lows where traders bought earlier. What happens if we just keep collapsing? I'll probably sell small, but right now, I want to sell a rally. I don't want to sell it below. Take a look at these charts. These are gap down days with a bear trend from the open. Okay? I want you to notice something about all these charts. You can just see it looking right here. Okay? A bear trend that lasted all day. A bear trend that lasted all day. Bear trend that lasted all day. Bear trend that lasted all day. And what do you notice? Almost all of them are small pullback bear trends. Right? They're pretty much all small pullback bear trends. Okay? How many of them look like this and just keep collapsing all day? Zero. Right? So a trend that looks like this is probably reaching down to support, and then it stops going down. So it's more likely that this will lead to a trading range than a trend day. I have lots and lots of examples of bear trends from the open. This one is similar to today, and it did go back last all day, but we had a couple big legs up first. So I think we're going to get some kind of a pullback soon. If we do get a couple legs up, maybe it'll become a small pullback bear trend. But right now, this is what it's doing right now. It's even more bearish than this. And even this, after about an hour and a half, became mostly sideways for the remainder of the day. Sideways to down, still getting lower lows, lower highs, but basically sideways for the rest of the day. And today is similar to that. A bunch of bear bars and a pretty good bounce and then down. But even then, we were sideways from here to the end of the day. So odds are we're going to go sideways. A lot of bear trends in the open, and the ones that last all day are the ones that do not get exhausted. They're the ones that have small pullbacks. They're small pullback bear trends. They don't have the huge bear bars. Small pullback bear trend, a lot of small bars and bull bars. When it goes down really, really fast, usually you're going to get a trading range. When it goes down really, really fast, usually you're going to get a trading range. Down really, really fast, usually a trading range. Down really, really fast, trading range. So probably not much left to the downside. Possible parabolic wedge, 9, 12, and 13. To buy above 13, you would need a really good looking bull bar. Or you could just buy at the market and use a wide stop, maybe a 20-point stop and scaling lower, 30-point stop. I would rather wait to see some bull bars before buying. But for the bears, at this point, I only want to sell a rally, because most of the time, pretty much all the time, when the market collapses like this, you're going to get a pretty good bounce. Now, I'm trapped out. I think we're going to get a parabolic wedge bounce for about an hour, starting soon. The bulls tried bar 11. They'll try again here. We went below the low the last hour. We fell below 12. And if I were still short, I would exit right here. I would bet against this lasting a lot longer. If we're still short, I would exit right here. I would bet against this lasting a lot longer. Sometimes rare things happen, and usually if something rare happens, I miss it, because rare things means low probability, and I don't like to take trades where the probability is too low. When you get a surprisingly big breakout, you look for a measured move down, and I mentioned how it might be a measured move based upon this. It went far below that. It might be a measured move based upon this, went far below that. And then another possibility is a measured move based upon the bodies of the bear breakout. So the breakout phase ended here with this smaller bar. So the body of the open of the first bar to the close of the final bar, that gets us here, and we're below that measured move. 60-minute chart, a 50% correction, and below pretty good support. Probably buyers soon, and probably not much more to the downside today. How many times have we had 14 consecutive bear bars? Really pretty unusual. I don't know if I have a streak like that. I have lots of different streaks. A streak is a behavior that lasts a long time, and that means it's unusual, and therefore it's unsustainable and climactic, and that it probably is not going to last a lot longer. Okay, there's a streak of 15 consecutive bear bars, and soon enter a trading range. Today we currently have 14 consecutive bear bars, assuming this remains a bear bar. I don't know that it will. But here we had 15 consecutive bear bars, and then we finally got a bull bar, and we got a small wedge. Really difficult for the bulls to make money. Buying above that, buying above this, buying above that. The bulls are not making money. For the bears, that's a reasonable short. We got a wedge, 1, 2, and 3. A wedge pullback to the moving average. So we put that there. That's a reasonable short. And outside down here, maybe a little bit, not much left in the day, but 13 bars without a bull body. So these are not bear bars, they're perfect dojis, but it's 13 bars without a bull body, and then we got a bounce. Similar to today, a very, very big sell-off, and another leg, and another leg, and another leg, and then we just stopped going down. This is what I think we're going to see today, some kind of a trading range. Is it still sell the close, sell the market? Yeah, but I'm not willing to sell down here. The odds are the bears will have an opportunity to sell at a better price at some point in the next hour or so. Bears, I'd get out of shorts at the market. I'd get out of shorts above any bull bar. I'd get out of shorts the size of a scalp above a bear bar, above 14. So I would get out. This is a parabolic wedge sell climax, 1, 2, and 3. And we're probably going to get profit taking soon. But as I said, profit taking does not mean the bulls can make money. There we go, a little profit taking, a little bit more, a little bit more. All right, so in these super strong bear trends, a lot of times it's difficult for the bulls to make money. Reversal up, reversal up, reversal up. Bulls never were able to make any money despite the reversals up. When it's hard for bulls to make money, it's better to look to short. If it's climactic, it's better to sell a pullback. And this is the biggest streak of bear bars that I've seen in the past several years. I've only been collecting streaks of bear bars for I don't know, maybe 5 years or so. Let me just see when this one was. That was in 22, so it's about a year ago. So I'm sure there have been streaks with more than 15 bars, but it's the biggest one that I've seen in the past several years. And therefore, we're probably not going to get many more bear bars. Again, a trend that looks like this is probably going to end up in a trading range for the rest of the day. So the first rally, probably not going to be all that big. Bulls looking to buy, better to wait for some kind of second reversal up. Better to wait for a second or a third reversal up. And even then, it's more likely the rally will not be all that big. If you're lucky, you'll get something like that to the moving average quickly. A low one, like 10, but different from 10, we've had 15 consecutive bear bars. Actually, 14. Bar 15 is a doji bar. It's not a bear bar, but it's 15 bars without a bull body. So we should get a bull bar on 16 or 17. Can this be a V bottom and the market just rally violently? It's possible. And can we keep going down? I don't think so. I think we're going to have to get some profit taking. The bears who sold here have a huge profit. The bears who sold here, their stop is, pick a price here, above the top of the parabolic wedge here. In any case, they're risking too much, and they'll be quick to get out. So most bears are going to be quick to get out because they don't want to risk all the way up here. And that's where their stop is. And, if you're a trader at a hedge fund, there's a guy called the risk manager, and he'll walk up and down the aisle and take a look at how much you're risking at any one point. He's not going to care if you sold here. If your stop is currently here, he's going to say you're risking too much. You got to lighten up. You got to take some profits. So it doesn't matter if you sold here or sold here. If your stop is up here, you're risking too much. And the risk manager is going to tap you on the shoulder and tell you, take some profits. And that's going to be happening at funds all around the world. And at some point soon, the next few bars, we're going to stop going down, and we'll get a couple legs sideways to up. So sideways to up for about an hour. Low one, parabolic wedge, 3 or 4 legs down. 1, 2, 3, 4. A new breakout, and then 1, 2, and 3. Should get some profit taking within the next few bars, and it probably will last about an hour, and then we'll probably be in a trading range for the rest of the day. When you have these exceptionally strong bear trends that enter trading ranges, the trading ranges often have a downward tilt, so they're more of a bear channel, but still mostly sideways. The bulls who bought the 9 low and bought more lower are losing money. We did not get above the 9 low. The bulls who bought the 12 low and bought more lower are losing money. We did not get below the 12, did not get above the 12 low. But these bulls probably will make money. The bulls buying, I'm not buying, right? But the bulls who bought the 15 low or the 14 low probably are going to make money. We'll probably go up at least 5 points above both of those lows at some point in the next several bars. Parabolic wedge, you could argue 12, 14, 16. You could argue that 13 is strong enough so that we might get one more leg down. So this might be a new leg 1, leg 2, leg 3. But this is probably the transition, the start of the transition into a trading range. 16 bars, no bull bodies. First reversal up, probably minor, but it could be sharp. This is so oversold, and once it starts going up, more and more bears will take profits, and we could get a short covering rally. Panic, bears panicking out of their shorts with huge rewards. They're so happy to have made so much money so quickly. And can the rally be also caused by bulls buying? I think it would be mostly bears buying back shorts. To buy, I want to see bulls make money before I buy. The bulls who bought the 15 low and bought more 5 points lower have made money. It's back above the 15 low, so they get out break even on their first buy with a profit on their lower buy. So first time all day when the bulls could make money. What about putting up a 1 minute chart and looking for a wedge bottom? I think it's a mistake. We probably, it's always going to form a wedge bottom on a 1 minute chart or a 30-second chart or a 10-second chart long before it forms a credible bottom on a 5 minute chart. But most of those bottoms will fail. So you'll take all these 1 minute trades and you'll lose on 5 of them, and you finally get a winner, and you'll make back maybe a third of what you lost. Not worth it. Who's selling down here? Not me. So I think the market is going to run out of sellers in the next few bars. Sellers at this price. The bears are willing to sell. I'm willing to sell again, but higher, closer to the moving average. Bulls who bought the 15 low made money. So now you'll start to get traders buying at the low of the prior bar and buying more lower. I'm not saying to do that, but if you're a fund and you can trade small and use really wide stops, you can do that. For me, I want to wait for it to clearly stop going down. I'm paying attention to the reality that bulls who bought the 15 low made money, and that will increase the number of bulls willing to buy the 16 low, and it will increase the number of bears willing to buy back shorts at a new low. And I'm not, even though it's extremely bearish, it's too bearish. I'm not willing to sell at the low. At this point, I only want to sell pullbacks. Another prominent tail. So we're starting to get more profit taking. Tail 14, 15, 14, 16, 17, and a doji on 15. 15, that means it went up and down. Still sell the market, sell the close, but I'm not willing to sell down here. I'm only willing to sell a rally. I'm obviously going to put this in my collection of streaks because it's the biggest streak that we've had in several years. 10 bars without, we have 10 bear bars. We have a 22 bar bear micro channel, and here we have 15 consecutive bear bars. And right now, today, we have 17 bars without a bull body. It's really exceptionally unusual, and that means unsustainable. We could get 18, we could get 20, we could get 30, but the chance of getting many more than what we have is small. Potential for a fairly sharp short covering rally because this is so extreme. Can you buy above 18 if it's a bull bar closing near its high? I'm not sure that it's worth it. I would rather wait for a strong minor reversal and then a test down and then buy a second reversal up. And bears, they could sell a first reversal up or a second reversal up. I always pay attention to gaps. And we have a gap between the 9 low and the 12 high. So that often will lead to a measured move. And we're beyond a measured move from there. But maybe that's the middle of the day. So maybe the measured move is here from the high of the day to that gap. The measured moves are support, but most support will fail to stop a strong trend. As I said, I looked at a measured move from here, went below it. Measured move from here, went below it. Measured move based on the bodies, went below it. Most support will not stop a strong trend. But when a strong trend finally ends, it'll end at support. Another low one, but as I said, 18 bars without a bull body on the open. I don't ever remember seeing that, so I'm not willing to trade it. You can see the 15-minute chart. A bunch of bear bars closing near their lows. Extremely bearish. Unlikely we'll get a big bull trend, but also unlikely it'll continue all day. Most likely we're going to enter a trading range. Probably soon. A bigger bar, a bigger reversal. So that could be a final flush. It's a bear breakout below, a bear channel. So you will get some bulls starting to buy, use wide stops and scale in. And for the bears, as I said, I would start getting out up here. So, I would miss all of this. I did miss all of this. What happens if we get a bull bar closing near its high? I've been saying don't buy, don't buy, don't buy. This is so extremely oversold. If we get a bull bar closing near its high on 20, if you want, you could probably buy it and put a stop below 19. This is a reasonable candidate for the low of the next couple of hours. What happens if it's a bull body, but only a 2-tick bull body? Probably not worth buying. You'd want a decent sized bull body, at least a couple of points or so. 19 bars without a bull body on the open. I don't ever remember seeing that. So very rare. A small bear body. So 20 bars without a bull body on it could still be the start of a big rally. We'll get fewer bulls willing to take the buy. For the bears, I'd get out of shorts. Now, I don't care if it's going to do this all day. The chance of it is so small, I'm happy to miss it. Can you sell the 20 high? No. Even though it's 15 bars in a micro channel, this is so extreme and so unusual that I'd wait for a couple legs up before selling again. Spike in parabolic channel. Target is somewhere around the start of that parabolic channel and somewhere around the moving average over the next hour or so. So bears will look to sell somewhere up in here. Obviously, nobody's buying above 20, at least not yet. But once it becomes clear that traders are taking profits, the bears who have not taken profits will buy back shorts, and we could go up pretty quickly. But there will be other bears looking to sell. I've been talking about trading range, trading range, trading range. Can this continue down all day? Very, very unlikely. But every now and then, the market crashes. It did in 1987. But very small chance that that's going to happen today. 21 bars without a bull body. Extremely rare. A low one, but we're starting to get dojis. Here, well, here and here. And then especially here, not only dojis, but smaller bars, overlapping bars. So this is probably the start of a trading range. And that means we'll probably get up near that price at some point today. Low one, but we're starting to get tails and dojis. So I only want to sell higher. 21 bars without a bull body. Extremely unusual. I said several times that when we begin the move down to below the October low, it'll probably be pretty quick. The bears are hoping that this is the first of many big bear bars and the start of the move down below the October low. I think it's probably just trying to get neutral ahead of tomorrow's FOMC. Well, we'll see. You know, one of these days will be the start of a very big sell-off. Remember, I think we're going, here's the weekly chart. I think this is where we're headed. We have a head and shoulders top bear flag. We may not get to that August high before we go down here. I'm trying to get some profit taking and tails here, and then doji, more dojis. So we're probably evolving into a trading range. And here we had a low one below 21. And 2 bars later, the bears have not even made a scalp. So momentum down is decreasing. This is bar 24. It corresponds to the close of the second hour. And even though we had a really strong gold trend, now we have on the 60-minute chart consecutive bear bars with at least one big and closing near its low. We have 2 big closing near the lows. So the 60-minute chart is sell the close, sell the market, but you're selling low in a trading range, which is not all that good. You also have consecutive closes below the moving average, with the body of the second bar completely below the moving average. It's also bearish, but the context is not all that good. It's after an extremely strong rally, and we're at the bottom of a month-long trading range. Just because the momentum down decreases does not mean that we'll get a lot of momentum up. When the selling is this strong, sometimes it stops going down and just enters a very tight trading range for a couple of hours. So I'm not at all confident that we're going to get much of a bounce here. If we do get a bounce, the top of it might be in this area where that first doji appeared in this final wedge. R24, end of the hour. Then we have a 60-minute bar closing near its low that increases the chances that we will go below the low of that bar, which means it increases the chances we'll get a new low on the day. But we'll see. This is so oversold that there probably are a lot of traders like me who don't want to sell at the low, but are willing to sell higher. Bears, I'd get out above 23. It'll be a double bottom and a second reversal up 20. So I would get out of shorts above 23. And for the bulls, where are the bull bars? Where are bulls making money? There's probably not a lot of upside potential until we start to see bull bars. And even then, with this much selling, I think the odds are against a big bull trend reversal. The best the bulls probably will get is a trading range. That's the end of the hour, and we have a bear bar closing near its low. The bulls are hoping to get a bull inside bar. The bulls are hoping we do not go below the low of the last hour. They're hoping they can stop the selling and maybe get a bull inside bar. And if they do, then maybe we'll go a little higher the next hour. The bears want the market to go at least a little bit below the low of the last hour. That will reduce the chances that we'll go a lot higher. Right now, it's unlikely that we'll go very high, even if we do get a reversal. Bears trying to get below the low of the last hour. Bulls are hoping for a higher low and the start of a swing up. If we reverse up, we have a double bottom, a neckline, and a measure move up would get us around there. Breaking below the low of the last hour. Next magnets are the 4100 big round number and that low from 4 days ago over here. Over here. The start of that big rally. They bought on 19, and most of the bars in here are having some buying. We're getting some tails. So the character of the market is changing from being extremely bearish to being slightly bearish. And probably will transition into neutral over the next several bars. Bears, no matter where they shorted, I would get out above the high of the prior bar at this point. This is so unusual. 25 bars without a bull body. I've never seen it before. And can the bulls buy? What are they hoping to gain? Right. Are we going to race up here? No. So it's really not a lot of profit potential for the bulls. And that is not yet good for the bulls. We need to start to see some bull bars. Any bull buying needs a wide stop. If you buy above 20, you need a very wide stop. If you buy above 25, you need a wide stop. So better to exit shorts and then wait to see what we get. Look to sell a couple legs up to around the moving average. And then if we start to get bull bars, limit order bulls, they'll be buying below things. They probably bought the 19 low, but they have not yet made money. It has to go up 21 ticks above the 19 low for them to make 5 points. Will the bears finally begin to take profits? Will we start to go up here? We can see there's still bears selling at the high of the prior bar, betting that the bear trend will continue. But I think there'll be fewer and fewer bears willing to do that. And you'll get more and more bears starting to buy back shorts. So we'll probably stop going down and either go sideways or up a little bit. Can the bulls get 26 to close above 25? Can they get 26 to close on the high of the bar? Can they get 2 or 3 bull bars closing on the high? The more of that they get, the more bears will buy back shorts and the more bulls will buy. Can they get a surprisingly big bull bar closing on its high. If they get that, if they do get a big bull surprise bar, that would increase the chances that we've begun a couple legs sideways to up. We have a bull bar. We have a bull bar closing near its high. We have a bull bar closing above the high of the prior bar. So the bulls are starting to do something good. The bar is not big, and it follows 25 bars without a bull body. Is it a buy above 26? Usually the first buys in a strong bear trend are limit order buys. Buying the 21 low, buying the 19 low, buying more lower, and scalping out. And usually it's better not to take the first stop order buy. So better not to buy above 26 or buy above 25. If we get consecutive big bull bars closing near their highs, then you might start to get some bulls buying the market for a scalp up. And if we suddenly get a bull bar 10 points tall, then we've probably begun a swing up. But right now, this is more likely a bull leg in what would become a trading range. The bears will try to get a double top 21. The bulls will try to get all the way up here over the next couple of hours. Can the bears sell below 27, double top 21? What did I say? I said this is unsustainable and therefore a climax. When a climax reverses, there will typically be two legs sideways to up. So do you want to sell below 27? That's one leg up. And why two legs up? Because the bears want to make sure the bulls have had every opportunity to convert this into a bull trend. So a lot of the bears will wait for two legs up before they're willing to sell again. 4120 and a multiple of 10, so it's a round number. So you get some bears selling there, some bulls buying, some bulls taking profits there. Again, the odds are most bears are not going to want to short until we've seen at least a couple legs sideways to up. Can you sell the market, sell bull closes and sell more higher? I would wait until we have a couple legs up. Can the bulls get consecutive bull bars? Can the bulls get consecutive bull bars closing near their highs? The more bullish things the bulls do, the more likely we're going to go higher. As I said, this looks like a channel. We failed to reverse up. We broke below the attempted bottom and are reversing up a second time. So a target for the bulls is around there, around the moving average. And for the bears, I would wait for two legs sideways to up before selling again. It's still possible that we reverse up all day. I think the best the bulls will probably get, if we do get a reversal, is maybe a 50% retracement. I doubt we're going to get anywhere near the high of the day. Is it buy the close? Yeah, it's buy the close, right? But if you buy, your stop is below 25. So you're risking 15 points, 20 points, or 15 points. And are you going to make 15 points? Well, you might. Bears, nothing to sell yet. Right now, we're always in long. Probably we're going to get a couple legs sideways to up, maybe to this area, maybe here, moving average. Bears, higher high, double top, 21. A low one, but I would not short. Chances are we're going to get a couple legs sideways to up. This is enough of a rally to generate confusion. Confusion is a sign that the market is probably in a trading range. So in confusion, you want to sell high. This is high. But if you have two big bull bars, you want to take a second sell signal, not a first. So most traders are not going to sell below 28. The bulls know that, and bulls will look to buy a pullback. I don't know that they'll buy the 28 low. That is too far above the low of the day, and the rally is not all that strong, and we're probably not going to go a lot higher. So it's too early to sell, and for the bulls, not a great buy. You could buy the market, you could buy the 28 low, the 27 low, use the wide stop and scale in, but I think it's better to do nothing now. The stop order bulls who bought 26 made money. They had to go up 22 ticks above 26, and it did. So not only are the stop order bears not making money below 24, the stop order bulls are making money 26. So those are two changes in the behavior of the market. It's a loss of bearishness and increase of bullishness. And as I said, trading range is likely, and trading range lasting at least a couple hours, maybe for the remainder of the day. The bulls are hoping that we'll do this, but I doubt the sell-off today is so big, so much bigger than this, I doubt we'll get back near the high. But if we do get a series of bull bars and a sell-off to a higher low, we might get a second leg up. I just doubt that we'll get back to the high of the day. I think the best the bulls can do is get back to the middle of the day. And even then, right now, maybe they have a 30% chance of getting to the middle of the day. I'm going to change that measured move to a 50% retracement. I do not think we're going to get there, but we might. And the more bull bars that we get, the more likely we'll get there. Okay, so that's exactly, or just about exactly at the March high. So there are two reasons to get there. This is a low from 2 days ago. I'm going to get rid of that. It's not that important at this point. Bears, a low one, a lower high double top, 15, buyers below, but we may get down to the 25 high. Why do I say that? Two reasons. So what do you think the two reasons are for us to get down to the 25 high? One is the market likes 50% retracements, and a 50% retracement of this rally is right around the 25 high. And the other is 25 is a bear bar. It's a bad buy signal bar. And when you have a bad buy signal bar and a bear trend, bears will sell the high of the bar and scale in higher. The size of a scalp, 2 times the size of a scalp, 3 times the size of a scalp, or they'll start selling 1 times the size of a scalp. So bears are either selling here and 5 points higher, 10 points higher, or they're starting to sell 5 points higher, 10 points higher, betting it'll go at least 1 tick below the 25 high, because that's what it usually does when you have a bad buy signal bar. Normally, you'll get a reversal to at least 1 tick below the high of that bar. And we just did. Okay? So the bears have sold the 25 high and sold more 5 points higher. They can get out break even on their first sell and with a profit on their higher sell. Is this back to sell the close? Nope. Look at the recent bars. Okay? When you see these recent bars, and I'll just show you, when you see this, you say, wow, it's so bearish, I got to sell at the low. Or do you say, wait a minute, there's buying going on. Look at all these tails and look at these bull bars. Do I really want to be selling in the bottom half of it? Probably not. Now, I said yesterday we had an expanding triangle top, and we did. So here's yesterday. We went up and down and up and down and up. And so an expanding triangle top. And then we reversed down. And so you got to be thinking, the market likes to do the same thing, over the course of several days. So we had an expanding triangle here. We may have to get an expanding triangle here. And to get an expanding triangle bottom, we would need another low. So we'd have a low, a bounce, bigger low, bigger bounce, bigger low, and then another reversal up. So I'm looking for a second leg up. I don't know if it'll be from a higher low or from a lower low, but I do think we're going to get a second leg sideways to up. At this minute, if I had to do something, buy or sell, what would I do? I probably would buy and use a wide stop and buy more lower. As I said, I would like to see 2 legs sideways to up before selling again after such an extreme climax. 28 is a bad sell signal bar. So what are bulls going to do? They'll buy the 28 low, buy 5 points lower, 10 points lower. So trading range behavior. Traders are thinking in terms of limit orders. Selling the 25 high, selling more lower, selling more higher. Buying the 28 low, buying more lower. And if this is a trading range, where are we now? We're in the middle third. In general, a bad location to do anything. Now, I said bears would sell the 25 high and sell higher. The bulls are not stupid. They know the bears will do that. So, and they know the bears will buy back shorts at the 25 high. So what are bulls going to do? Some of them are going to buy at the 25 high, just where the bears are buying at the 25 high. And other bulls buy the 28 low. Other bulls will buy the 25 low if we get there. Other bulls will wait for a bull bar and a higher low, a small head and shoulders bottom, left shoulder, head, and right shoulder. Can you make money selling the market here? Yes. Can you make money buying the market here? Yes. So if you can make money buying or selling, the market's probably in a trading range. The bulls would need a wide stop and they'd have to scale in lower. The bears need a wide stop and they have to scale in higher. But we're probably in a trading range. And we're probably going to be in a trading range for at least a couple of hours, maybe for the remainder of the day. Because this is so bearish, there's an increased chance if there's a trading range that the trading range will be tilted down. When you have really big sell-offs on the open, well, here it's not tilted down. Well, when you have really big sell-offs on the open and you get a trading range, a lot of times it's more of a broad bear channel. So it's trading range, but kind of tilted down. You know, downward tilt, a little bit of a downward tilt. Big sell-off trading range. We got a new low, but then they bought it. So all these are examples here. Lower highs, lower lows, a new low, but they bought it. Big sell-off, big rally. And then we got a higher low, we got a double bottom, higher low. So any of these things, you know, very strong rally up from the sell climax and trading range. So, you know, I don't know which of those days will be similar to today, but right now, 60% chance trading range. Remember what I said when we started to get the bear trend from the open? Okay, when we started to get the bear trend from the open, I looked at this chart and I said 20% chance it'll last all day, 20% chance you'll get a reversal into a bull trend, and 60% chance you'll be in a trading range. So 60% chance this is what the rest of the day will do, sideways. So traders will look to buy low, reversals up from the bottom, and sell high, reversals down from a rally. And if the leg down is strong, they'll wait for a second reversal up, a micro double bottom or a high 2. If a leg up is strong, they'll wait for a second reversal down or a low 2 or maybe a wedge rally. And the bulls, they'll buy a wedge sell-off. They'll buy with limit orders at new lows. The bears will sell with limit orders above prior highs. Top of the range probably will be up here. Bottom of the range might be here, might be a little bit lower, but probably not much lower. What would I need to see to decide that we're going to do this? Here we got a pretty good rally, and we just kept going down. I need to see a breakout to a new low pretty soon, and I probably would like to see 1 or 2 more buys that are brief. So, you know, right now I don't think we're doing that, and we're clearly not doing this. Here we got 5 bull bars, and we broke above the moving average. A very strong minor reversal followed by a major reversal. So right now we're not doing that, and we're not doing this. So we're probably doing this. 60% chance trading range for the rest of the day. What happens if 30 is a bull bar closing near its high? Then we have a higher low, probably not a major reversal. Extremely strong bear trend, and only a 3-bar rally here, only a 1-bar sell-off here. it's not a big enough pattern to be a major reversal. But we could get a second leg up to the moving average, maybe all the way up there. To buy above 30, the bulls would need a really good bull bar. And for me, that's not good enough. The bears are hoping 29 is a resumption of the bear trend, and that 30 is a pullback, a low one, but not a good enough sell. Probably buyers below 30, buyers below 29, buyers below 25, maybe sellers above 30. A lot of the bears want 2 legs up before selling again, and probably sellers 28 high and higher. All right, I'm going to step aside. Brad is coming in now. We're probably in a trading range. We're now in the middle of the range. Bulls would rather buy a reversal up from down here, and the bears would rather sell a reversal down from up here or here. Okay, hope you have a good day.
So overall, certainly a big sell-off today. There we go. So as Al was saying a few minutes ago, we have probably evolving into a trading range. We have 4,100, just a little bit below. And let me just lock that. The rally from 26 to 28 is probably strong enough for at least a small second leg up. So while buying above 30 was not ideal, and 29 is strong enough, it'll probably get a second leg down. Probably not going all that much lower before we go sideways. So in other words, I think the bulls who bought the 26 low are probably going to make money here. Now, if you're a bull and you're buying, let's say, the 30 low, where's your stop? Well, it's really not that simple, because you could put a stop below 25, but the problem is if you put a stop below 25, you really want to sell right where traders are probably buying. So if anything, I think a bull that buys the 30 low, if anything, I think they're buying more at the 25 low. So strong sell-off, strong rally, probably sideways. Really fascinating how we only had 3 bull bars in 30 bars. So 27 out of 30 bars today are bear bars, and we had 25 non-bull bars in a row. So that is certainly a sign of strength. But probably buyers down here, probably going to get to the 28 low fairly soon. Why would we get to the 28 low? Well, for one, there's a few reasons. One is it was reasonable to buy the 28 low, even though it was high in the range. And the other reason is it's a breakout point. Breakout points in trading ranges often close. Just as Al mentioned over here, we rallied up to 28. We had a strong bear sell-off, and we have a bad signal bar, 25. There was probably sellers above 25, and those bears will often sell the 25 high. They'll sell a measured move up of the signal bar somewhere up here, betting that the breakout point will close. The bulls, they'll do the same thing. Some will buy the 28 low, others buy at the 25 high over here, and a lot of them scalp it out, but some of them will wait for this breakout point to close. So when you look at 30 and 31, does that look like the start of a strong sell-off, or does 30 and 31 look like the start of more confusion? And to me, it looks like the start of more confusion. So to me, I think we're in a trading range. Even if we sell off all the way down to the 25 low, there's probably buyers below scaling in lower. And even if we get above the 26 high or the 28 high, there's probably sellers above scaling in higher. I'm going to work on answering more questions throughout the day, so I'm going to go ahead and just open the webinar box in case someone wants to ask some questions. So here, possible inside bar second entry buy, probably going to go to the 28 low here fairly soon. So bulls buying, scaling in lower, just as the bears sold and scaled in higher. So what happens if we break above 28? Is it a double bottom and we're going to go for a measured move? Probably not. At a minimum, we are probably going to go to the moving average, but probably not that much further before we find more selling. It's really interesting, when you get here's the daily chart, and sorry about that. Here's the daily chart, and what's really interesting about it is we had two strong bull bars here, but if you look to the left, tight bear channel, and we broke far above it. However, at a new high, we found sellers, and we raced all the way back down. I thought there'd be buyers below. Give me just 1 second. Let me adjust the gain. It keeps correcting itself. But anyways, I thought there'd be buyers somewhere below, scaling in lower. But this is strong enough to make me think it's going to have a second leg down, and the bulls that bought up here are trapped. If the bears are lucky, it'll be similar to March the 7th. We'll get a bad follow-through bar on March the 8th and a strong second leg down, or we'll just get a strong bear bar tomorrow. So it'll be interesting to see how this bar closes. But overall, good sign for the bears. I'm turning off the screen for just a second, but again, I think this is about testing the high of the 28 low. 4-bar micro channel with 28, 29, 30, 31. So some sellers above 31 betting on a second leg down. Okay, some questions. Is 25 the bottom of a trading range? Yeah, it is. We have 2 or 3 pushes down. We broke below it, reversed up. And the bottom of the range is anywhere down here. So the bottom of the range might be the 25 low. That's why if you're buying here, it's really better if you can buy more down here. Was there a tell earlier? Someone's asking, was there a sign that today would be such a large sell-off? Maybe. I mean, you always have to wonder on the daily chart when you get 2 big bull bars and we get a bad follow-through bar. If it's a double top or a wedge, 1, 2, 3, it's also a possible expanding triangle. So here, 1, 2, 3, 1, 2, bad signal bar on April the 26th. Always have to wonder if this strong sell-off is going to lead to a test here. But, bar 1, we gapped down, and bar 1 tested the lows of over here, bar 64 from 2 days ago, and you end up getting weak follow through, but it's still follow through on bars 2 through 6. And it basically forms a micro channel, and then on the report at 9:05, at least I think there was a report on the 9 o'clock bar, we went outside down, and it became sell to close. And it was sell to close all through here. And if you're a bear and you're selling stop above and you trail a stop, there's really no reason to exit. So traders trail, and some of them at this point, bar 14, 15, 16, a lot of them would get out, 1 point or maybe 1 tick above the prior bar. Some maybe would get out here, others would get out a couple points above, and we just drifted sideways to down. But overall, it was certainly strong. Okay, question, is it reasonable to buy? And by the way, if you're asking questions, try to give a reference point, like a bar number. Question, is it reasonable to buy where trapped bears are below 23 to 24? Yeah, that's part of a trading range. Bears sell, they scale in, they're going to be disappointed down here, and they'll buy. And bears would buy on a retest. That's why I was saying that for the bears, for the bulls, if you're buying in here, it's typically better if you can buy more at the 25 low because the market will probably go sideways. Question: are gap bars reasonable sells on days like this? Or is it more for trends that are likely to last all day? No, it's reasonable like this. This is so climactic that it's probably going to have to go sideways for several hours, maybe the rest of the day. And whenever you get a strong sell-off, you can see the open gaps. So no open gaps in here, but tight bear channel. 6, and then the close of 7 creates a very large gap, and then 9 closes far below 8 and below 7. So lots of open gaps. The pullback on 10 kept the gap open at the 8 low, and we formed gaps just almost all the way down. Gap here, 12 high, 14 low. So what are the odds we get a measure move down to here? I don't think we will. We're so close to the big round number that you have to wonder if we will get to it. But to me, I think we're going to try and get to the moving average first. So to me, I think sideways here is more likely. Question before signing off, Al said, the trading range. Okay, question before signing off, Al said that the trading range started around the high of bar 15 here. What makes that the top of the range? Question mark. I thought the range would be where we started to go sideways, but bar 15 we're still selling off. Yeah, it's really because of these tails. So any one of these rallies is the start of a trading range. The market rallied, sold off, rallied on 12, sold off, rallied on 15, sold off. So why not, if 15 is the possible start of the range, why isn't 12 the possible start of the range? One reason is because 12 is a doji, but 13 is a pretty strong breakout bar. So it could be resetting the count. And if you think about it, a breakout, the market cycle resets. You have a trend, a channel, then a trading range, and then a new trend. And an easy way to think about that is you get a breakout that forms a trend, that forms a channel, and then it forms a trading range, and then you get a new breakout. And here we have a trading range. So we broke out to the downside on 11, sold off, formed a trading range bar on 12, and then broke out again on 13. So it's kind of like resetting the count. It's resetting the breakout. Even though this whole thing is a breakout on a smaller time frame, you would see this reset it. 14 starting to channel, and then 15 an inside bar. And then when you look at 16, 17, and 18, it's good and it's going down, but lots of tails below. So you could argue that it might be the start of a lot of buying pressure. So if we look at a 1-minute chart, you will see strong breakout, big bear bars pulling back sideways, then here more and more buying pressure. But it really doesn't matter. I mean, the reality is we could go all the way up to here. Even if we get up to here, probably sideways. At a minimum, I suspect we're probably going to get to the moving average here. Question: would a second entry buy be reasonable with a tight stop, or would you wait for a fully formed first bull leg up? Well, if you're buying above bars like 33, then the problem is if you're buying above a bar like 33, stop below 33, you have small risk reward. You have small risk, big risk reward, so you know you have low probability. So it's really not that great of a trade, but some traders will buy it. To me, I think we're probably going to go sideways, and I would rather wait and see what the breakout above the moving average looks like. Question: do you use TradeStation also as your trade execution platform? If yes, do you use the matrix? Yeah, I use the matrix pretty regularly. So I have a chart, matrix on the left side of the screen, and There's buttons on the matrix: buy at the market, sell at the market, close the trade. You can obviously click on the matrix if you want to buy with a limit or stop. But yeah, I use it pretty regularly. Okay, I'm going to take a break from questions, but I will ask more here. I'll answer more shortly. So 32, 33, good for the bulls, but we're so close to the moving average that we're probably going to find sellers fairly soon. So what happened on bar 33 when 34 closed? And in other words, what made the open of this bar immediately sell off? Well, if you're a bull and you bought above 33 and you're clearly disappointed by the follow through of 34, what are you going to do on the open of this bar? You're going to sell. So a lot of traders, they bought above 33, which I would not. They were disappointed by the follow through, their entry bar 34, that as soon as it closed, they immediately started selling. Possible triangle forming. So for me, I would be very patient here. And the reality is we're probably going to be fairly neutral for quite some time. So I would not be in too much of a rush here. Bulls getting to the moving average. Probably sellers not far above. So probably more profit taking up here than anything. It's possible we go a lot higher, but I suspect there's going to be traders disappointed who bought the 28 close and the 28 low, that they will probably use this area to take profits. The bulls really need to break above the moving average. But they need to get strong consecutive bars above the moving average. Otherwise, probably traders selling up here, scaling in higher, betting on a trading range. So until the bulls break far above 28 and the moving average, the reality is there's probably bears and bulls selling up here. For the bulls, they want a breakout of a triangle and the measured move, low of 29, high, which takes you up to here. They might get it, but as of right now, probably more sideways. Good bar for the bulls, but probably sellers not far above. Micro channels of 29, so that reduces the probability for the bears. But I suspect there's sellers at the moving average. For the bulls, probably better to take profits up here and wait for an upside breakout. Now, if 37 is a bear bar closing on its low, do you sell below it? Some traders will, but to me, it is a problem with all of these tails below. It's still 2 legs up and a possible double top, and we break somewhere down here. But there might be more buyers below 37 than sellers, but I certainly would not buy below 37. 2 legs up after a strong sell-off, we could easily test down to the 29 low. So to me, I think we're going sideways in here. You can see some traders, some bears sold the 35 high, scaled in, disappointed, trying to get out break even at the breakout point, the 35 high. Traders buying the close at 37, trying to prevent 37 from triggering. Even though it's a 5-bar micro channel with the 37 low, I still suspect that the market's probably going to have to pull back and test the apex of this triangle in here. So far, this bar looks good, but they still probably need to do more here. Can the bulls keep the bar? Can the bulls get the bar to close on its high? And then the next piece, can the bulls get a strong follow-through bar? Otherwise, probably sellers not far above. Here's a 15-minute chart, and you can see sellers above. So what happened to the strong bull bar? Well, everybody sold on the way up, betting that the bulls were going to fail and the bears were going to win. And it's really frustrating when you see bars like 37, good looking signal bar, but not great context. 7, it's a 5-bar micro channel. Then the market breaks above 37 and 36 on the current bar further than what you want. But the context is bad. Strong bear breakout, been below the moving average for a lot of bars today. You have to assume that the market's going to fail up here and go more sideways. So traders start selling above bars, betting that they'll at least be able to make whatever the risk is. You can see this rally retested the 14 low, sold off. So again, I think we're still going back to the apex. So if I had to guess, we're probably going to test somewhere down here. We're probably going to try and go about 5 points lower before we go much higher. Typically, the first touch of the moving average is sold. So to me, bad signal bar, 38 low, but probably sellers above scaling in. And we're probably going to go below the 38 low. We may have to test the 38 high first. The bulls can still break out above 38, but if they're going to, they need to show signs of strength here. And they need to exert control. Otherwise, sideways to down is more likely. Some bulls bought the breakout during 38, and they're deciding right here, are they disappointed by the rally to 38 that they're going to try and sell out of longs at the original entry? So on a 1-minute chart, bears, bulls buy the close, they buy more lower, and they use this bounce to try and sell out of longs at a higher price. And that is in part what this rally caused. So to me, I think we're clearly in a trading range, and we don't know where the bottom of the range is. Obviously, the 29 low and the 25 low are magnets. I wouldn't be surprised. You always have to think about major trend reversals. We have 2 legs up, 25 through 38, so a decent amount of bars. I wouldn't be surprised if the bulls are lucky, we'll probably sell up. Maybe we'll sell off to the 29 low in the formation of 10 or so bars, 10 or 12 bars, not too tight of a channel, kind of like this. But we get down to the 29 low and form a bottom and a decent signal bar. That might be enough to break out to the upside. So you always have to wonder when there's 2 obvious lows, 25, 29, that the market may have to fall below one of them, but not fall below the prior one. And that's pretty common in trading ranges. But regardless, I think we're in a trading range more than a bull trend. Trading ranges have deep pullbacks, and that means that bears who sold down here and scaled in will probably be forgiven. Which means the market will probably test back down to the 41.15 area. Inside bar, bulls, they want an upside breakout, but still, it's bull close above the moving average, good for the bulls, but the reality is there's still probably more sellers up here than buyers. It's a more extended micro channel, 33 to 39, so that's good for the bulls. But to me, this is an area where traders are taking profits more than where traders are establishing longs, which means there's probably more sellers up here than buyers. Tight bull channel And some traders will see it as a parabolic wedge, so 34, 36, and 38. By the way, if you have questions, try and answer them. Try and ask them in the GoToWebinar. It's easier for me to keep up with them. But possible parabolic wedge here, here, and here. Second entry, it's kind of like a second entry short. It's an inside bar. And 40, what do you do with that? Well, it's another small bar inside of 38. To me, it's an extended micro channel. So 1, 2, 3, 4, 5, 6, 7, 8 bar bull micro channel lowers the probability of a short. The bulls, they might get the upside breakout, but I suspect that we're going to evolve into a trading range and go sideways here. So the bulls are trying to get support at the moving average. And it's kind of interesting. They have a gap here. So the 33 close, 37 close. So it's a small negative gap. Then we broke to the upside, pulled back, and we're kind of forming a small gap in this area. It's hard to see, but it's kind of implied. This channel up so tight, though, that the first reversal down is probably going to fail. And a lot of traders who were sold and scaled in are probably disappointed here. So I suspect we're not going to go straight down to the 29 low. We're probably going to try and sell off and go sideways somewhere in this area. In the bulls, they want the opposite. They want an upside breakout and a rally up to the 15 high, somewhere in here. Looking better for the bulls. So the question is this going to be a measuring gap, or is this going to lead to exhaustion? So far, good bar for the bulls. But what will it close? How's it going to close? Is it going to close on its high, or is this bar going to close the big tail? It's really common to get, whenever you have a trading range environment, to get a strong looking bar right before the market reverses. So you have to wonder right here is if this bar, this could be the top of a trading range. We may get a small second leg up and then start to go sideways. So it's really important to see how this bar closes. Will the bears that sold the 40 high and scaled in higher make money? So good looking bar, but we still have about a minute left in the bar, and we could easily close somewhere back below the 40 high or the 39 high. And it's another 3 pushes up, 36, 38, and 41. And the bulls want some form of a measuring gap. But to me, the reality is I think there's sellers somewhere up here. And we're probably going to go more sideways. So 41, a bull bar, but it closed under the 38 high. So this next bar is an important bar. Will the bulls get follow through, or will this be exhaustion and lead to the top of the trading range? Notice how the bears who sold the 40 high and scaled in made money if they scaled in or sold higher. And they're getting the opportunity to exit at the 40 high. So ask yourself, if this is going to be a strong bull trend or a small pullback trend that started around the 31 low, should the bears make money selling above bars? Probably not. Micro channel since 33, yes. But to me, this looks like a leg in a trading range. The bears are making money above bars, and that's a problem for the bulls. So this makes me think, and also the context is bad. We've just had too much selling pressure today. Therefore, the odds favor more sideways. So bears what they will do is they'll sell at the moving average, they'll sell as it goes higher, and they'll look at 41, and as it's going up, bears will laugh and they'll sell. And because they know the odds are, they're getting an opportunity to sell at a very expensive price. So what a great opportunity to sell at what could be the top of the range. And if this is the top of the range, we could get all the way back down to 41.15. So bears can sell and scale in, and they've got two likely outcomes. One, a trading range, which we could easily go all the way down here, or two, a bear flag, which means we could sell off all the way to 4,100. So even if bears sold here, scaled in, and the risk was bigger than they wanted, they can probably get 1 times their actual risk. So that's why it's just really, when you look at this, you have to wonder, this just does not look, it's a tight bull channel, but it's just making it too easy for the bears to sell and scale in higher, which to me increases the probability that the market is going to go mostly sideways rather than up. But this is damaging to the bulls, to the bear case. So it increases the probability that there's buyers somewhere below. Bulls, they may not buy up here, but they can probably buy and scale in, and they'll probably make money. Even if a bull buys the close of 41 and they buy more down here. So it sounds crazy, but bulls, they buy here, maybe they buy more down here, put a stop somewhere down here. The reality is they're probably going to make money. It's not a great trade because it's buying what could be the top of the trading range, but some bulls will do it. Bulls are hopeful that this current bar was a pullback from the 41 bull breakout. More likely, it is probably going to lead to more sideways trading. But you have to give the bulls credit. They are certainly trying hard to get the upside breakout. High one buy 42. So the question is this the start? Is this a high one buy in a bull breakout, or is this a high one buy at the top of the trading range? If it's a high one buy at the top of the trading range, there's probably more sellers above the high 142 than buyers. If this is a high one buy in a strong bull trend, then there will be buyers above 42. So the question is 42 the opposite of 10? And we're going to get a strong entry bar on 11, trapping all the bulls that bought below 10, or is this top of a trading range where there's probably more sellers at the 42 high than buyers? To me, this is the top of a trading range, which means there's probably more sellers above 42 than buyers. So 43 might be a second entry short that leads to a test somewhere down here. It's really important to understand in strong breakouts, first legs of moves like this, it's sell for anything. Sell below here, sell below here, sell below here, sell anywhere, betting on lower prices. When you see this, legs in a trading range, you have to be very careful about buying the second or third leg up. And even these, it looks like it's parabolic, 1, 2, 3, but when you see these, this is so tight that it's one big breakout. And here, 1, 2, 3, even this parabolic wedge, 34, 36, and 38 failed. And now you have to say that maybe this is the parabolic wedge. And when you're in a possible small pullback trend, you can keep redrawing wedges and they continue to fail. But when you're in a trading range, usually wedges work. So you can see some traders sold above 42, scalped out around the midpoint of the 42 low. But I think we're probably going to have to go a little bit lower. 20 gap bar sell. So if this bar closes on its low, you may have more bulls giving up. Bears sold down here, probably scaling in higher, which means at least 80% chance they'll be able to break even around the midpoint, which would probably be somewhere in here. Good for the bulls. A lot of bears scalped out that sold above 42, and they weren't willing to swing trade because they were worried that this is a possible small pullback rally that could last a lot higher than what seems reasonable. But still, unless the bulls get a strong breakout with follow through, we're probably going to continue to go sideways and eventually go down. Bulls doing a good job, and it's certainly a problem for the bears. Is it always in long yet? It probably is, but I don't know. I think the bulls need probably one more bar, but it's certainly enough to limit the downside. A lot of bars up since 32, and a micro channel, which is good for the bulls, but lots of tails above bars. So I think until the bulls can really get a strong upside breakout, probably still going to go sideways. But this is certainly a problem for bears, and it's okay for the bears to be flat here. Momentum trying to increase for the bulls, but still, this could reverse back down. So it's important to wait and see what this bar looks like. Will this bar close on its high, increasing the odds of higher prices, or will this bar sell off into the final seconds of the bar and disappoint traders? And you can see, when you look at this rally, trading ranges often get bursts of momentum to the upside just before it pulls back. They get bursts of momentum to the downside just before it reverses. Big bull bar, pulls back, rallies, pulls back, big rally, pulled back. So to me, I think at least 50-50 chance this reverses down, and it may be higher than that. This is just not what you want to see if you're a bull. Lots of traders who bought the 43 close are scalping out. And if they're you have to ask yourself, why are bulls scalping out? If traders were really confident that the market was going to go a lot higher, they'd be buying aggressively. And typically, when you look at bars like 43 and 44, 44 as it's going up, you look at it and you think, yeah, this might be always in long, but I don't know, maybe the bulls need one more bar. Maybe 44 needs to close on its high, and it doesn't close on its high. And you're thinking right now, well, maybe 45. If 45 can close as a big bull bar above 44, then it'll be always in long. And typically when you see that, and the market needs one more bar, that can often be a reversal point. It's still a strong micro channel, with the exception of the 41 low, so I guess it's not really a micro channel anymore. It's a tight bull channel, but to me, still looks like a leg in a trading range. So if this bar closes on its high, then we could certainly still go higher. The problem here is how tight this rally is. So it's basically a small pullback trend on a smaller time frame. Let me try to go to something like this. So the bulls want an endless pullback. But when you look at this sell-off, you have to think probably going to go more sideways here than straight up or straight down. This is a 15-minute chart. With 3 or 4 or 5 consecutive bull bars, probably buyers below and at least a small second leg up, so that will reduce the downside. But to me, we're probably going to have to pull back first before we go a lot higher or a lot lower. And the strength of this rally also reduces the chances that we get all the way down here. Still probably better to wait and see what this bar looks like before buying. And there you go. Just as you start to get hopeful that 45 is going to close above 44, it starts to pull back. Very tight channel, but when you look at it, look to the left. It's a tight channel following a very strong sell-off, and that will probably limit the upside. I'd probably be out of longs here. I think trading range day or trading range price action, and we're a lot closer to the highs than we probably are to the lows. And the reality is we'll probably have to at least go sideways for 5, 6, 7 bars. So to me, there's less upside risk than downside risk. And probably going to go sideways somewhere in this range. Weak signal bar, 45. Possible wedge, 38, 41, 44. Still low probability short below. And the bulls are hoping for an upside breakout and a measured move. Maybe the 38 low to the 44 high. And they might get it, but I think probably sellers not far above. But very difficult to make money selling in this rally. Bad signal bar for the wedge, 35. And it's also a minor wedge. It's parabolic. So you have some traders buying the 45 close, betting that it's a bad signal bar and we may break out to the upside. When you look at this, it's confusing. It's a tight bull channel, but it's a tight bull channel following a very strong breakout. And where are the consecutive strong bull bars? So while the first reversal down will probably fail, it would not take much to make the market go sideways here. Bulls getting new highs from the rally that started at the low of the day. But where are the strong closes at new highs? Why did 46 fail to close above 44 or 45? Bulls are hesitating at new highs, and that's a sign that the market is probably going to pull back. Small pullback trend though since 29, so we can go a lot higher. So probably better to be flat and wait to see if the bulls get a clear, strong upside breakout, or if the bears can develop more selling pressure. Always in long, good bars, 46, 47. Probably going to go at least a little bit higher. But let's see how this bar looks. So this might lead to a measuring gap, but lots of damage, and the bulls need to do more. But to me, 46 and 47 might be the bull breakout of a bear flag, which means we could get some sort of measured move up. But low probability. Typically, when you get a strong sell-off, it's possible you get an endless pullback, but probably need some kind of major trend reversal, which means this is the 32 area, 31 area is probably not the start of the major trend reversal. which means we'll probably have to pull back at some point and test down here. Even if we get a strong rally up to this area, we will probably have a deep pullback. So what are some targets? One is a 50% pullback of the rally, low of 25 here, which takes you somewhere up here. Possible measuring gap from the wedge, 38 low, 44 high, takes you up to here. Here is the midpoint of the sell-off. Disappointment bar, 48, small body, big tail, but the sizes of the past three bars increase the probability of higher prices. So still tight bull channel, and bears unable to make money below bars. So it's still a small pullback trend and probably going to go at least a little bit higher. Bears starting to sell, bulls taking profits. I still think we're going to evolve into a trading range, but hard to sell below bars when the channel up is this tight. So still probably going more sideways to up till the bears can get more selling pressure. Small pullback trend, so still too early to be selling. And, what are the chances that we rally a lot higher? I don't think we will. I imagine we will probably begin to go more sideways. But the reality is this channel is a breakout. And so far, the bulls are doing a good job. You can see it's an endless pullback. We get a bull breakout, which was pretty much 46, 47. So you have to wonder if we're going to get some kind of measured move up. And right now, the bears are just not making any money. So to me, I think it's too early to be selling. Other targets, maybe the midpoint of 12, but that's basically around the midpoint of the sell-off. So to me, I think we're trying to get to the midpoint of the day and find out if there are more buyers than sellers. This rally on the 27th and 28th of last week was strong enough that there were probably buyers below scaling in. And I suspect a lot of those traders who bought and scaled in lower are so disappointed that they will use the first bounce to sell out of longs. So to me, that will probably limit the downside or limit the upside. But I would certainly wait to sell. The bars are small. There's not a lot of energy, at least in just one bar. But when you look at this from the standpoint of time, the bulls are doing a lot of damage. So it's important to realize that this is what it looks like on a 15-minute chart. Let's take a look at a 30-minute chart. 30-minute chart, no different. Lots of strong bull bars. And you never know. I mean, what are the chances that we just rally all the way back up to here? I think it's pretty small without testing back down. But when you see this kind of a rally, you know the first reversal down is going to fail. And if the first reversal down is going to fail, then a lot of traders they'll buy back shorts and buy aggressively, betting on at least a small second leg up. So to me, low probability that this is going to lead to reversal and without going first sideways, but we could easily get up to this high, the high of the 10:30 hour midpoint of the day, but probably going to pull back fairly soon. Definitely confusing though. small pullback trend after a very strong sell-off. But better to wait for increased selling pressure. In some bulls, it will just trail a stop. They'll be long, or they'll buy at the market, and they'll put a stop maybe below 50, or maybe twice the size of this bar down. And what they'd be doing is basically, their premise would be, as long as the bears can't make money below bars, then we're in a small pullback trend. And they will stay long, and they'll stay long hoping that we continue to drift up, or we race up strongly to the upside, and they'll sell out of longs. That's why it's typically better to wait for the bears to develop more signs of strength. These small pullback trends can just go on a long, long way. I think the market wants to see what's at the midpoint of the day. Good bar for the bulls. Probably going higher. This red line is just the midpoint of bar 12. It's just a potential resistance level, but it doesn't. I think the more important resistance level is the 50% pullback. Can you sell the close of 52 betting on a climactic bar, best looking bull bar in the rally since 29? I would not. While 52 may pull back, just look at how difficult it is to sell. The bears just are not making any money, and that is a problem for selling. You know, these rallies can be really upsetting, because you look at it and you think there should be a pullback, and there should have been. There should have been bears. We should have sold off. We should have gone sideways more, and instead we're breaking out to the upside. And we can go a lot further than what seems reasonable. So another way to think about it is, you had bears who started selling into shorts, positioning themselves to be short, betting on a second leg down. And those bears are taking a lot of pain on the way up. And it's not as obvious as the sell-off. So because of that, when you get this, a sell-off that looks like 7, 8, 9, it's so strong that it usually, I mean, obviously, when's the last time you've seen 24 bear bars in a row? But the point is, it's usually unsustainable and will not last all that long. These small pullback trends can trap a lot of traders and get very strong upside breakouts. So this is why I would not be selling. We're completely ignoring the midpoint of this bar. So the next target, pretty much the midpoint of the day. Again, better to wait and see the bears make money or do something strong. 52 and 53 are breakouts. 53 might be exhaustion, but I don't know. We could just race up really, really quick. So in general, I think it's better to not start selling aggressively in small pullback trends. They're really dangerous, because I have a measured move. You can see this measured move target was completely ignored. And next target is, while this probably is going to lead to sideways trading, you always have to wonder, is this the target? And maybe this is the target right here. So yes, we're pulling back some, but to me, you know, just look at a 30-minute chart over here. Are you eager to be selling when you see this? Of course not. You're thinking that, you know, maybe we can get all the way up to here, 41.60. We probably won't. We're probably going to go sideways fairly soon. But this is a lot of damage done by the bears. And again, it's in part the daily chart. We have a strong rally. Bears, they sold the April 26 high, scaled in higher, made money. What do you think is going to happen to the bulls that bought the May 1st low? They scaled in lower. Some bought the breakout point. Some will get out break even, but the reality is they're probably going to make money. You look at, if you compare it to this day over here, March the 7th, we had 2 strong bull bars and a big bear bar on March the 7th. If we look at it, let me turn off the screen and pull up another chart here. So tail, but probably buyers below and going at least a little bit higher. But the tail is a warning that traders are beginning to take partial profits. Anyways, I want to go to March the 7th real quick. For those of you that have TradeStation, if you type .ld space and then the date, month, day, year, it's a shorthand way to pull up a day. Come back to that in just a second. So some profit taking after 53, but who's going to sell? Who's selling here? Well, in part, it's some bulls selling out of longs, taking profits, and some bears selling. But to me, unless, maybe if 54, the current bar, closes on its low, traders will start to sell out of longs. But I think the bears need to do more here. This is good. Bears selling, bulls selling out of longs, bears selling, bull closes. But to me, it increases the odds of more sideways. The bears need to do more to reverse this. But when traders see bars like this current bar, they start selling back at the high close. So that will increase the chances of more sideways trading here. Some bulls exit below 54. Other traders will wait and see what the next bar looks like. Can the bears make money selling below 54? But 54 is a disappointment bar, and traders will use any bounce after 54 to start selling out of longs. Traders giving up. So strong enough bars, probably going to have at least a small second leg down. Some bulls buying the pullback, betting that the market will at least have to go sideways rather than straight down. But if you're a bull and you bought, how are you feeling? Well, obviously you're disappointed. And if you're disappointed, a lot of those traders are going to look to sell back at the 53 close. So still probably going more sideways here than straight down. So I suspect that the bulls who bought the 53 close and bought more lower, like below 52, are probably going to make money. And at a minimum, we're probably going to get back to the 53 close. It's certainly disappointing, and the size of 55 increases the chances of more sideways trading. So I suspect the upside is probably limited. Bears getting the downside breakout. Strong enough sell-off, probably at least a small second leg down from 54 to 57, but probably a trading range, so probably more sideways here, and then straight down. Market trying to test the 28 high, the area where traders got trapped. Is it always in short? It might be. It's a 4-bar micro channel, So I suspect sellers above and probably going at least a little bit lower. But big rally, big sell-off, confusion. So probably a deep pullback first. This is what I was talking about, a deep pullback. So if you're a bear and you sold the 57 close, you probably, unfortunately, get out above 58. Micro channel, yes, but fairly tight channel up to 53. So the pullback could get all the way back to the 53 close. Some traders bought the 56 low, scaled in lower, using 58 to sell out back at the 56 low, but probably sideways to up here. And I think we're going to try and get closer to the 53 close. All right, so ended up going sideways for 2 bars on after 58, but this is kind of what I was talking about. Bears, they see a bear breakout on 57, and they look at it, and it's strong enough for a second leg, but it's probably the bottom of the trading range. So a lot of traders will sell and scale in, and a lot of those traders don't want to sell down here because they know that the bottom is probably somewhere down here and the top is probably somewhere up here. Plus, like I've been saying, it was reasonable to buy the 53 close, and the bulls that bought the 53 close never had a chance to get out break even. So if you're a bull and you buy the 53 close, you expect buyers below 54, you're clearly disappointed with 55, 56, 57, and you scaled in lower. What are you going to do on a bounce? You're probably going to be interested in trying to buy back shorts or sell out of longs back at the 53 close. So to me, that makes 53 an obvious magnet for the bulls. And if you're a bear, you know that. So if I'm a bear, why would I sell 57 if I think that there's going to be bulls scaling in to shorts? This channel up was so tight that the odds were there were buyers below. So those bulls buy below, and they are probably going to look to get out somewhere in here. Look at some questions. Okay, question about bar 6. This was at 11:12, about a few hours ago. But they said, question, I looked at selling bar 6, close, but shied away from it. Missed many big moves recently, trying to formulate binary if-then statements, that process. Any suggestions to help get past this? Yeah, I think a lot of things can be summed up. You know, if you look at the course, a lot of it can be summed up in binary decisions. Give me just half a second here. Wanted to check the gain on this microphone. But a lot of decisions in the Brooks trading course, if you listen to Al, are fairly binary decisions. The market's either in a trend or trading range. That's a binary decision. If it's in a trend, is it tight or broad? If it's tight, only look to buy. Is the trend in a breakout or a channel? If it's a strong breakout, sell immediately. So if it's a strong breakout, 7 and 8, sell the close, sell for any reason. If it's a weak breakout, look to buy pullbacks. Weak breakout, 57, sell a pullback during 58. And, you know, for me, I think flowcharts can be really helpful with that. So you start thinking through a flowchart. If it's a market cycle, I'll pull one up in a second. Let me just see. I've shown one before. Let me see if I can pull it up real quick. 62 is enough of a surprise, though, while I'm pulling this up, that the market's probably going to test closer to the 53 close in 58. And, you know, for me, I think flowcharts can be really helpful with that. So you start thinking through a flowchart. If it's a market cycle, I'll pull one up in a second. Let me just see. I've shown one before. Let me see if I can pull it up real quick. 62 is enough of a surprise, though, while I'm pulling this up, that the market's probably going to test closer to the 53 close So big enough surprise on the prior bar that I suspect there's buyers below this current bar. Here's a basic example of a flow chart. Trade range, is it tight or broad? If it's tight, wait for the breakout. Do you have a breakout? No. Wait for the breakout until you get a breakout. Trend, is it a breakout or a channel? If it's a channel, is it tight or broad? So that's one way I would think through it. But I would definitely try and make your decisions easier. Let me just see one thing real quick. So 62, good for the bulls. It's a trend line break from a micro channel that ended on 60. So some traders will sell above it. But to me, probably sideways. And when I compare the rally up to 53 versus the sell-off down to 57, to me, the rally is stronger. 7, to me, the rally is stronger. So probably buyers below 63, buyers below 62. It's possible the bears get a second leg down from the sell-off from 53 to 57. But so far, bulls have not had a way to exit that bought the 53 close, and I suspect they probably will. You can see 63 went one tick below 62 and immediately reversed up. So buyers below 62. Question about, do I prefer to draw support resistance on the Globex chart, which is the ETH chart, or extended trading hours, or do I prefer to draw on the RTH, which is the ES.D chart? For me, I like to draw most things just on the ES or the ES.D, which is the day-only session, and because it corresponds to the stock market. So I like the fact that it has 81 bars to the day. It keeps it simple. But you can certainly draw support or resistance with the overnight session or the Globex session, or in this person's question, the ETH chart. So question about, are we going to get a second leg down? We might. Typically, I think we're going to get a second leg up first. This is a tight bull channel, probably buyers below and a second leg up. But what'll be interesting to see, I also think the sell-off today is strong enough for a second leg down. So if you're a bull and you bought below yesterday's low and more at the April 26th high, the breakout point, you're disappointed, but we will probably test back to this area at some point. It happened over here on 25. It was reasonable to sell the 25 high and scale in. And then you can see 28 sold off sharp, 29 sold off sharply back to the breakout point, 25 high. And then it took a few bars and reversed back to the 28 low. So what do you do here? Do you wait for the breakout? Do you buy here? Well, the more we go up, the closer we will probably be getting, the closer we're getting to the profit-taking zone. So a lot of traders will look to sell somewhere in this area. And again, the 53 close is a logical target for the bulls. So I think at a minimum, we're going to try and get there. We don't have to stop there. We can try. I still think it's reasonable to test the midpoint of the sell-off, which is this line right here. But right now, good bar 62, disappointment 63. Let's see what this bar looks like. Will 64, the current bar, be a strong bar closing on its high? Or will 64 be a weak, disappointing bar. If 64 closes on its high, I suspect the follow through will be bad. Possible wedge, 58, pullback, 62, pullback, and then up here. By the way, again, if you want to ask questions, go ahead and just ask them in the webinar in the GoToWebinar question box rather than the Discord. It's easier for me to keep up with them. And that way I can delete the question after I know it's been asked, so I can just kind of go in order rather than having to scroll through Discord. So getting vacuumed up to the 53 close. I know it looks scary. You see this, the problem with right here is traders buy the 53 close. They buy late in a trend, and it's probably not going to go much higher. And there's two types of traders that do that. There's the smart traders, the institutional traders, who buy, and they're buying all the way down. They'll buy more above a bull bar. They'll buy here. They'll buy the 53 low. They'll buy the 52 low, and they'll scale in lower. And then as the market goes down, they know it's converting into a trading range. So what do on the rally? They exit. So if you buy up here and you bought more lower, you're disappointed. And if you're disappointed, you're going to look to exit shorts. That's why this is probably going to stall. It doesn't have to stall, but it's the same thing down here. Bears sell all the way down. They'll sell, and that's part of the reason why breakouts happen. You would only be willing to sell a breakout if you thought it would at least stall or go a little bit lower. And a lot of traders, what they will do is, give me 1 second. So anyways, if you're selling a breakout like 7 or 8, the only reason you would sell it is if you thought it was strong enough for lower prices. And traders will sell. They'll sell every tick all the way down, knowing they can scale in when the market goes against them. And that's what traders ultimately screw up in when they're trading, is, especially traders starting out, is they'll sell on the way down. They get the right idea. They'll sell on the way down, but they panic when they see this. There's two ways to exit a trade. You exit early or late. The early exit is as the bar's going up or maybe a couple points above this bar. The late exit is 28 close. So the worst thing you can do here is you look at this breakout 26, 27, and 28 and say, oh my gosh, I sold the low close. I sold all the way down here. This is going to race all the way back up. I've got to exit. And traders inevitably exit. Same thing right here. This breakout looks strong, but ask yourself, what are traders doing here? Look at the purple line. Why are we bouncing? You know why we're bouncing. We're bouncing because traders who bought, scaled in, are exiting. I was one of those traders, and I wasn't alone in that idea that traders can buy up here or be long and just buy more lower and get out. But one important thing happened here is, to me, this was a bad area to buy. It wasn't bad, it wasn't the greatest place to buy to begin with, but if you're long and then the market went far against you, what are you going to do here? You're going to exit. Look at this bear bar. Traders, some unfortunate person sold the low tick of bar 29, and then they see the pullback. What are they doing? They're disappointed. They sold, scaled in, getting out break even. And that is why breakouts happen. So I hope that makes sense. You can say the same thing anywhere. If you're and let's add one thing really quick. So 38, 37 are similar to 52, 53, but they're a little bit different at the same time. 38, 37, and 38 are within an overall trading range day. 52 and 53 are part of a small pullback trend. And we had a strong breakout, yes, but this is very impressive, and there's not a lot of bars to the left. So it increased the chances that the first reversal down would fail, and we would test up to here. So what about selling the close right now, betting that we're going to evolve into a trading range and test the 60 high, the 61 high? In other words, what about selling here, betting that this is like 28 And let me back up. If you're selling here, it's the opposite of down here. We retested the high of 25 during 29, 30, 31. So if you're buying down here, you're betting on these breakout points closing. Selling here, you're betting on the high at 60 and 61 closing. And that is a reasonable trade. And it's certainly okay to do that, it's okay to do that, but it's a tight bull channel. Here, it's a possible parabolic wedge. Let me draw it. When everybody agrees the market's in a trading range, they trade it differently. Nobody wants to buy high in a trading range. Everybody's happy to buy high in a strong trend, such as a small pullback trend or a tight bull channel. Everybody's thrilled to sell low in something like this because they know even if it pulls back, 5 points, 10 points, it's going to lead to lower prices. Here, same thing. But when they have to hold through several bars and then they get a retest, traders start to sell. And a lot of traders, I was kind of one of them, where if I'm long, I'll almost always take part off around the close, sometimes maybe the midpoint of the bar. So I'll take part off, so I took half off at the high of 64. And I thought about taking a chance, see if we break out to the upside. And we started to go up and just kind of hesitated for a couple seconds. So I ended up just closing the trade because the odds are I'm going to be disappointed. So I would not be surprised one bit if we get back to the 62 high, the 60 high, and we go sideways here. Okay, question. What is your opinion on immediately, and before I answer this question, I think it's okay to exit longs here. Tight channel from 58 to the highs of 65, but probably going to go mostly sideways here. Okay, so question, what is your opinion on immediately pricing a break-even stop loss to prevent profits from running into losses? The trader's equation becomes positive since the actual risk is technically a profit. Yeah, and it really depends on, depends on where. So, to give you an example, mathematically break-even stops are stupid. They don't make any sense. But a lot of traders use them, and it's reasonable to use them. From a pure math standpoint, it would not make sense. It's a completely emotional and psychological thing to do. That doesn't make it wrong, but that's reality. And the reason for that is what you're in essence saying is by getting out break even, you're accepting it's someone else's money. When the reality is, if you're long and you buy here, you take part off and you put your long, maybe a runner, and your break even is down here, and you move your stop to break even and say, oh well, I'll either just let it get hit and I'll take a break even loss, or this will run a long way. And there's logic to it, but there's no mathematical logic, because what you're in essence saying is I'm willing to buy a position up here and put a stop down here. And if you're not willing to buy at this exact second, then it's a bad trade. Whenever you look at the market and you say there's no way I would enter here, but you're long or you're short in that direction, it's a dumb trade. But to answer your question about break-even stops, sure. If you are, if you bought above, let's keep it simple. So you sold anywhere. You sold anywhere during this rally, and you're all the way down here. Obviously, if you sold the 12 close, and now the market's down here at 25, the last thing in the world you'd want is for it to hold and to get stopped out back at the 12 close. You would take a loss. That would be a very poor trade. It would not be good. And same thing with selling 54. If you sold the 54 close or the 52 close and you held through this and you say, oh, I'll just move my stop to break even, that wouldn't be smart, because the market's going to retest the 53 close, 54 low area. So I hope that answers the question. But in general, should a trader, if you are unable to exit quickly, you buy 60 and you're unable to exit quickly up here, in general, it's better to just scout, take all off at twice your risk, or certainly move your stop to break even, yes, but the better thing to do is to try and figure out how to exit up here. Use a price action exit. 65, still always in long, trying to break above the 53 high, but we're stalling. And the longer we stall, the more likely we're going to go sideways. And break-even stops, really, part of my problem with them is they're in essence, they're skunk stops. They inevitably force traders to enter or exit too late. So if you're a bull and you buy the close at 53, you don't want to exit down here. If anything, you want to buy more down here. If you're a bear, you don't want to sell down here. And if you did sell down here, you don't want to exit necessarily up here. If anything, you're selling more up here. But that's not really ideal. You're selling low in a trading range, and you're selling high in a trading range, which is good, but we could still get an upside breakout. Okay, another question. So 66, a good bull bar. Probably, the midpoint of the sell-off, not that much further above. So probably going to go at least a little bit higher. Still always in long, but if the bears get a bear bar closing on its low, I think it's reasonable for traders to look to exit. I accidentally deleted a question. I apologize for that, but it was around 1:55 Central Time. So I'm going to answer the question from 1:55 on, and if yours didn't get answered, just retype it. Do you use a 1 or 2 minute chart? Yeah, sometimes. I'll sometimes look at a 1 or 2 minute chart, but it can be fairly dangerous to do because you'll start to ignore. You can use any time frame as long as you can keep up with the price action. I think most traders will be better off and can make more money if they would just use a 5-minute chart or a 10-minute chart or even a 15-minute chart. But you can certainly trade 1-minute charts. And, if you ask I would argue, a lot of really good price action traders, many of them trade 1-minute charts and 2-minute charts, but their ability to read is very, very good. Two more seconds here. Outside down 67, and you can see traders took profits. What about a second leg down after 67 and a test of the 60 high? We might get that. To me, it's a possible second entry buy with this current bar, and it's probably and it might be an inside bar, but tight. It's forming a trading range, so probably sellers and more sideways. Let me go back to questions really quick. So I think most traders are better off waiting for an upside breakout. Okay, follow-up question about the break-even trade. I used the wrong terminology. They said I meant initially using a break-even stop and then trailing it to be an automated exit. If it went below bar 12 and I entered the 12 low. So if it went below 12 here and they entered on the 12 low. Yeah, I'm not sure. See if you can type that question a little bit more, but if I hear you right, what you're saying is the faster you move your stop to break even, the more frequent you'll get stopped out, if that makes sense. So if you're selling the breakout on 12 and it immediately goes down and you move your stop to break even, most of the time you will get stopped out. Occasionally you won't though. So the tighter your risk, the lower the probability, but the better the risk reward. But for me, I think it's okay as the trade goes your way to tighten the stop. So you sell the 13 close, stop above 13, or maybe a little bit higher. And then you get 14, 15, 16, you start moving your stop above every other bar. And you get out above any of these bars. I think that's okay to do. But if I did not answer your question, just see if you can give an example. Okay, so this current bar testing the high of 66, probably sellers above scaling in higher. So I suspect, even though it's a second entry buy, it's probably going to lead to more sideways trading. 67 went below 66 by at least a couple of points, and that will increase the odds of sellers above the high of this bar and the high 67. So far, good looking bar for the bulls. But let's see how this bar closes. At support, the midpoint of the sell-off. So we may pull back. But so far, good looking bar for the bulls. So probably at least a small second leg up after 68 and 69. But getting late in the day, so probably more sideways here. The bulls really need the strong bull close here. Otherwise, traders will still see it as part of a wedge, 58 or 59, 64 or 65, and then the rally on 69. So this might be more of a profit-taking bar than an area to buy. Some traders, when they see a bar like 68, they will look to sell the high of 68 and sell more a measured move up of the bar. Others just sell a measured move up of 68, so they look at it like this. Here's the range of 68, and they think to themselves, it might go 1 times the initial risk, but it's probably not going to go 2 times the initial risk. So some traders, they sell the high of 68 or maybe the high of 55, or even 1 times the range of the bar up, betting that the market is going to get back to the 68 high. So in essence, what they're doing is they're betting against the break-even traders or the limit order traders. Break-even traders, they buy above 68. As the market goes up, they move their stop to break-even, and they usually get stopped out. And that's because limit order bears who sell the high of 68 and scale in typically make money. So that's what the market's deciding here is the market going to test back to the 68 high, or is this a breakout of the past 15 bars and are we going higher, like to the 60-minute moving average, which is this dotted line right here. Probably going at least a little bit higher, consecutive bull bars. Good for the bulls. But we still may have to test the 68 high first. And here you go. The market is testing back to the 68 high, the area where the bulls, the bears that sold the 68 high, got trapped. Okay, let me go back to this question. So, question, could you explain why gaps are so important and what they basically mean? I have been through the course. That's good. Also, I see a lot of emphasis put on gaps on the open and the E-mini, and I don't get what this means. So they're asking, yeah, what's a gap? And then they go on to say that, in essence, it's a long question, so let me take a look at it really quick. Yeah, so what they're asking, they're mainly asking about gaps during the day session. So you see a gap down and the point behind looking at gaps. A breakout is a gap is a breakout. They're all the same thing. And the point by that is a gap is price was above or below. It doesn't matter. I mean, I would see, so let's look at it like this. It does not matter that we gap down. What matters is the market went from here to here. So the market just sold off. We can look at the ES, it doesn't matter. And the way I look at it is here we have a strong rally and we reverse this sharply. This whole thing's a sell-off from this high yesterday to this low is a sell-off. This low, 426, to this high is a rally. And gaps can help signify how easy or difficult it was to make money. So what did I mention through here? I mentioned that it was difficult for bears to make money. If you sold the 35 high and you sold more on 36, what if you had your target at the 35 high? You would not have gotten filled on 37 and the 38 low. That means it's difficult to make money as a bear. If you sold any of these highs, let's say you sold the 42 high, you scaled in more on 44. Look what happened at the 45 and 46 low. You couldn't make money. So gaps, really, they help explain how easy or difficult it is to make money. The harder it is to make money for one side, the more likely it's going to continue in that direction. So the sell-off, 7, 8, 9, it looks scary during the fact. You look at it and you think, how can the market go lower? But the reality is, bulls are not making money. And if bulls are not making money, the market is going to go sideways or down. Same thing here, all the way down. And then eventually, 22, 23, 24, 25, any of this area, bulls are making money below bars. So look right here. Bulls that bought the 69 close, they were very disappointed on 70. So a lot of traders, they buy the 69 close, they buy more below the 69 close and scaling lower, betting they can get out break even. It's a smaller version of what took place on 53. Bulls buy the 53 close, they buy more on the way down, and they get out break even. So for me, I was one of these bulls. I thought that the market would, I really did two things here. I sold a little above 68 and scaled in, and it went further than I thought it should go. Therefore, I got out, I sold, scaled in, got out break even on the trade. As the market came closer to this high, it was a little aggressive. I bought at the market on the way down and scaled in lower, betting that the market would probably, it may fall a little bit, but it's not going to fall that much. And on the bounce, I got out basically a little bit below the close of 69. And my premise was, if I'm a bull and I bought the 69 close, I'm disappointed. And if I'm disappointed, it's probably going to continue sideways. So gaps explain, and let me go back to this person's question in particular with gaps. What I would ask you to look at and think about is, think about gaps from the perspective of who's making money. So I'm always thinking about limit order traders and the counter trend traders. How easy is it to fade a breakout? And the more difficult it is to fade a breakout, then it's very one-sided. Here, it's a little bit one-sided in this area, but if you sold the 66 close, you made money on 67. If you bought the 67 close, you made money. If you sold the 67 close, sold more above the high of 67, you made money on 70. So it's becoming more and more neutral. Neutral means both sides are making money. Here, this is the exact opposite of neutral. This is extreme, and you cannot make money buying below bars. You're just going to get killed. And over here, a little bit different. Tight bull channel, so the first reversal down should fail. Even this sell-off all the way down to here. If you bought somewhere around 48, bought more lower, you made money. So why did 70 reverse down sharply? Well, look at it. Are we in a trend or a trading range? Sure, it's a strong channel, but this is within a large trading range. So what are you going to do? You're clearly going to look to sell out of longs up here. And that's why there are more traders selling the 70 close than buying. So you can see this bar is bouncing around. And look at the high close. Bulls buy the close of bar 69 at 42.75. Look at the high of the bar, 42.25. It came within 2 ticks and sold off. Now we have a high one buy on 71. But who in the world is going to want to take that buy? If I had to guess, there's probably more sellers above the buy than buyers. If I had to guess, there's probably more sellers above the buy than buyers. We sold off on 70, deep pullback during to 71, probably going to get a second leg down. Let me answer some more questions. Okay, question, how long is the 20 EMA, and this was asked on 201, so 20 minutes ago. How long is the 20 EMA gap bar argument valid? Bar 54 here would technically be a gap bar, but it's obviously not good. Well, all of these are gap bars. And the way I look at that is 2 ways. One, you never know. Strong sell-off, consecutive sell climaxes. You never know how deep the pullback's going to be. You also have to think about 20 gap bar on a 5-minute chart it's just one time frame. But you can often get 20 gap bar buys on several time frames. So let's go to a 15-minute chart. We touched it, sold off, rallied a little bit higher. 5-minute, we went far above it. But what about a 30-minute? Sold off, we're getting close to it. What about a 20-minute? Is this 20 bars? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. That's 18 bars. About a 17-minute chart. Probably almost 20. But the point is, it varies. Consecutive sell climaxes, deep pullback. To me, when you get this tight of a channel, it's probably going to go more sideways. So as far as selling here, when the channel is this tight, the only thing I would do, I would wait to buy and wait for a second leg up. So probably sellers around here, scaling and higher, but the downside is probably limited. And you can see sellers above 71 for a second leg down. Probably continued sideways and disappointment here. Let me go back to some of the questions here. While I'm doing that, I want to glance at the reason why I brought this up, I wanted to see how deep the pullbacks were. So this was, let me just go to 3/9. Let me just pull it up really quick. This area here on 3/7, we had this big sell-off, pullback, big sell, and big second leg down. And really, we could actually just do it like this. One thing that's easy to do if you have TradeStation, you can go to Drawings and click on Fibonacci Price Retracement Calculator. You can click the high of the bar, low, and this pullback, and it gives you a percentage. So it pulled back 40%, which is deep, but it's under 50%. And if you look at this, let's just go to the, let's do like a 15-minute chart. scrolling, calculator, high to low to here. It's about a 37%. So it's a deep pullback, but it's under 40. So from here to here, today looks fairly deep. And if you count it from here, here to here, it's about 50%. But the point I'm making is we could easily stall and get a second leg down. So I do not think this is a trap for the bears at a minimum. The bulls have done a good job, but I suspect we'll probably test back down to the 1030 area over the next couple of days. Can you touch on how difficult it is for you to change your mindset to reverse logic that more experienced traders require? Is it simple repetition and practice to get you through the other side? I think, everybody's different, and I think you have to spend a lot of time studying, and I make plenty of mistakes. And, I like to think of it as I get better, I make less and less mistakes. The key, I believe, is learning and trading small in the process and remaining comfortable with what you're doing. That is single-handedly the most important thing. If you can remain comfortable with what you're doing, you will probably be okay for the long run. Most people, they press it too fast, and a lot of it's just doing what you should do, what you know you should do. So if you are, if you're long on 6 and you see 7, you just have to get out. It doesn't matter if your stop was here. You have to exit. Even if your stop got turned off on 7, you exit. And on 8, the only thing you can do here is short. And if you're long, that means you're not short, and therefore you cannot be long. So you have to get out. If you sold for any reason here, and then somewhere over here you're starting to get a lot of bull bars, you just exit. You have to exit and consider reversing. So I think the most important thing traders have to do is not be so hard on themselves with making mistakes, and learn to accept mistakes and move on. 73, big bear bar, probably going to get a second leg down. When you look at 73, you look at the bar and you say, 73 is big, and that probably should not have happened. Therefore, it's probably going to get at least a small second leg down. So it might be more of a sell the close bar on 73, betting on a second leg. So we may test back down to the 60 high, 64 low area. But to me, you got to learn how to read price action, and then you have to learn how to be honest with yourself. And that's, I think there's an art, let me get a sip of water. There was I don't remember if it was an Ask Al video or a podcast Al did. And anyways, on the podcast or said video, Al said that one of the most important traits with trading is to be honest with yourself. And the longer I trade, the more I totally agree with that logic. You really do have to be honest and truthful with yourself. And too many traders, they lie really to themselves. They remain in denial about a trade that they're in. They see 6 or 7 and they buy for whatever reason, or they try and pick bottoms thinking that this can't go on forever, or they start selling, betting on a second leg down, and just keep selling, and they can't take the pain on 53. That is one of the biggest mistakes traders make, is they cannot grasp. Or to give you another example, they buy the close of 69, disappointed with 70, and instead of saying, well, I should probably try and get out as close as I can to break even, they just say, you know, that really, I hate that. I'm going to just stay long because it didn't give me what I wanted, when that is not the right thing to do. So they sell to close of 57, disappointed 58, but rather than trying to get out at the 57 low, they stay short, and they end up getting out at the highs up here. Highs up here. So the first thing is learn how to read price action. The second thing is learn how to trust yourself with price action and be honest with yourself when you're wrong. Big bull bar on 74, starting to rally. 2 legs down to the moving average. Tight trading range late in the day. Probably going to go more sideways. So not really that great of a buy above, not really that great of a sell above either. Good bar 73, bad bar 74. So the bears break out 73, disappointment 74. What do you think those bears are thinking right now? If you sold 73, are you happy, or are you saying, yeah, I don't know, this is not what I really wanted to see. If I sold the 73 close and sold more higher, maybe I should just try and exit around break even. And that is what a lot of traders, I suspect, are doing here. They're disappointed, and if they're disappointed, they're looking to exit break even. Looking to exit break even. So let me go back to questions here. Now, some bulls, they bought the 72 low and more below 73 and 74. They bought here, they scaled in lower. They're getting out, break even, back at the pullback. Okay, question, I bought above 33 here, but mismanaged the small pullback trend all the way up. And I basically broke even. And they basically broke even. So follow up to the question, I keep scalping out. Can you comment on how you have to be more confident to swing? Yeah, so this person's, what they're saying is they bought above here, but they ended up getting out around break even. I'm not sure what they did. I suspect that maybe they bought above 33 and got out when after they saw 34, they ended up getting out on the retest. But anyways, their question is they bought above 33 and they couldn't hold. And can I comment? Yeah, swing trades never look like swing trades. A swing trade never looks like it's going to be high probability until it's gone a long way. Case in point, look at this rally from 35 anywhere, or maybe 35 here. So I suspect this person, they bought above 35, they moved their stop to break even and probably got stopped out or got out below the bear bar, and they couldn't find a way to get back in. And if you go back to what I said, I thought it was reasonable for me. I was looking to sell at the moving average, and I sold and I scaled in. And I can't remember what I did. I think I sold, scaled in, and I think I reversed to long somewhere in here. But I mismanaged that. The point is, small pullback trends always look like legs in a trading range until they keep going further and further. So if you really go back on the recording, you'll hear me change my opinion just back and forth on every bar, where I thought we needed to test lower, but it seems like every other bar, something different would happen. And before you know it, you start to see 41. I thought that might be exhaustion, but then 42 falls below it and is a high one. I thought there'd be sellers above. But then you get 43, 44, closing as bull bars, and then 45, possible wedge, but it's parabolic. and tight, which means it's probably going to be minor. And anyways, on a higher time frame, it's a breakout. So what I would work on is focusing on two things. One, think about what a higher time frame looks like when you buy above 35. And then the second is ask yourself, did you exit? Why did you exit when you got out after 35? If you buy 35, what was your premise for exiting? So look right here. What happened here? Well, bulls, they saw a second entry buy. By the way, we could get a fast sell-off. I don't think we will, but you have to wonder. We'll get a bear breakout, test of the lows down here. But I'll talk about that in a second. What I want to go back to is this bar right here, 74. You look at 74 and say it's two legs down, 70 and 74. It's a second entry buy. It's a reasonable buy. But I mentioned 73 was a surprise. Bulls bought 72, scaled in lower, 73, 74. And some of those bulls are looking to get out, break even, back at the 72 low. And if you're a bull, if I'm a bull and I bought 74 and 75 is my follow through, I might be quick to exit. Why would I be quick to exit? I'd be quick to exit because it's not really an ideal trade. Because if you're buying, for one, it's two legs down at the top of the trading range. And trading ranges often get really disappointing. They often get bear breakouts of bull flags. Here is an example. So we could easily break to the downside really quick and test down to here. We probably won't, but you have to wonder, is this going to lead to a sell-off back to the 57 low? So let's look at a higher time frame. It never looks like it, but you have a sell-off and then a new high. Some traders will sell in this area, betting on a second leg down. Now for the bulls, they want a wedge. Sell off on 70, 74, and then down here. So if this bar fails to close far on its low, you may have bears be quick to get out. The bears know that it's not a great sell right now, but they're hoping for a sharp downside breakout. So the risk is small. Maybe their stop is the high of this bar. Maybe it's somewhere here, but they may also be using a time stop. If you're a bear and you're selling, you're not going to give this trade that long. You can see what happened. That tail was just enough to disappoint traders. And because of that, a lot of bears who were going to sell, when 76 closed and had a tail, they immediately started buying. Still, tight bear channel. If this bar closes on a tie, we may try and rally, but getting late in the day, probably better to wait. So you can see that traders disappointed who bought up here, tried to get out 72, went down further. Some of them selling because it's high in a trading range. Therefore, traders not interested in buying the close. The size of 76 increases the probability of at least a small second leg up. But with it being this late in the day, better to just wait and do nothing. When you have a bar like 77, it's forcing you to risk a lot of points, more than one. Let me just do it this way. You buy the close of 77 here and put your stop here. So you buy this close, stop below. 1 times your risk is up here. And this bar alone is, let's just say, 8 points. So do you really want to miss? What's the probability if you risk 8 points right now, or maybe it's 6 points from the close, but let's just say it's 6 points. What's the probability if you buy the close here that you're going to make 6 points for the market before the end of the day or before you get stopped out? And to me, it's marginal. Therefore, it's a bad risk-reward trade with not great probability. So some traders will try and buy a pullback, maybe the breakout point, the 76 high. But with it being late in the day, I think better to wait. And that is why it was a bad buy, the close bar. Some traders, they see a bar like 77 and they give it a few minutes. And when the bar fails to race up quickly, they exit the trade. Watch what happens at the 77 close. Bulls buy the close of 77, they scale in lower, confident that the market will at least let them exit back at the 77 close here. And by the way, if you're in the Discord, ask your questions in the Go to Webinar. There should be a way, the panel that, whether you're on the desktop version or an iPhone or an iPad, you should see a question box. So ask your questions there, and just so I don't miss them. I'll start the end of day review here in just a couple of minutes. So let's take a look at the daily chart. And daily chart, we completely undid all the damage here. Trading range price action, bears, they had a breakout point on April 26th. Bears sold it, scaled in higher, and they made money. So they sold more anywhere up here, like the April 18th high, and they made money. Bulls bought the low of yesterday, bought more at 50%, and some just had limit orders to buy the breakout point, and they made money as well. So fairly neutral going into tomorrow's FOMC report. Strong enough bear breakout, probably at least a small second leg down. Strong enough bull breakout, probably at least a small second leg up. Just like the bears who sold the April 26th high and scaled in made money. I suspect the bulls who buy the low here and scale in will make money as well. Weekly chart, almost outside up, and then big bear bar, probably going sideways here. First bar of the day, bar 1, gap down, big bear bar. Second leg down from the 61 bear bar yesterday. The size of bar 1 is big enough to make me think that we will probably get a small second leg down. But it's also a big enough bar that there's probably buyers below 1 scaling in lower. And then 2, a second bear bar, but failed to close under the bar 1. But it's a big bar, and it at least went several ticks below bar 1, so it's a breakout. In general, consecutive bear bars make the market always in short. But to me, I suspect there's buyers not far below, and the market's probably going to go mostly sideways. Three consecutive bear bars. Is it sell to close? It might be, but probably going to have a deep pullback. So always in short, yes, but to me, not really that great. Looks like an early leg in a trading range. And then bar 4, 4 consecutive bear bars in a 4-bar micro channel increases the probability of sellers above and traders selling the close, but still not clear. And then 5, another bear bar. So now we have 5 of the past 5 bars on the open are bear bars, so probably sell the close, but low 1 short on 4. There might be more buyers below. And then 6, a further breakout, but buyers at every bulls and bears both buying into the close, and we're getting tails below bars. Probably sellers above 6, sellers above 5, but probably more sideways than straight up. And then obviously bar 7 outside down changed the characteristic of the market. Bar 8, consecutive bear bars, it's sell to close. It was sell to close arguably in here. But to me, 7 and 8 reset the count. Consecutive bear bars, sell to close, stop above 8, stop above 7, probably going to go lower. So traders will sell, betting on lower prices. And then 9, another big bear bar. 3 big bear bars, it's becoming climactic, but when you see that, you can argue second leg trap, but to me, this is so strong that the reality is traders are selling and selling really above anything. But the risk is big, so you need a wide stop. And then 10, a low one short. Let me adjust this. There we go. Try to make the bars easier to see, or the numbers. That should do it. 10, low one short, probably. It's still sell to close. Sellers below bars, strong enough breakout for a second leg down, likely, but big bars, big risk. So if you are selling, better if you can trade small and use a wide stop. And then 11, another big bear bar. 12, a doji, pause, hesitation, but still sell to close. Probably going to pull back fairly soon. These are very big bars, but their average size over the past 5 bars. So while they are climactic, yes, big bar, another average size bar. So both of these bars are about the same as far as the width or the body. A little bit more bigger bar here, climactic, and then a pause bar, another big bear bar, and then a pause. Probably going to pull back for at least a bar or two, but this is very strong in going lower. So the only thing you can do is sell. And then 13, another big bear bar, still sell to close, but probably going to pull back soon. 14, still sell to close. And then 15, another low one short. Probably traders are still selling and selling below bars, selling above bars. There might be more buyers below 15, and the market may have to pull back, but even if there are buyers below, they're scalping, so it's really not that good of a buy. And then 16, another bear bar, but pretty big tail, so a warning that the market may start going sideways soon. Same thing with 17, 18, an inside bar, but you can see bulls at best are buying for scalps. 19, big bear bar with the tail pull, and then rallied into the close. It's another bear breakout below a bear channel that failed. Probably going to start going sideways fairly soon. And then we obviously went sideways to a new low on 25 and reversed up. Tight channel down, pretty much a tight trading range from 20 to 24. So a possible final flag on 25 broke to the downside below 24, reversed up. What about selling here? Well, at this point, if we've had 24 bars without a bull body, and that will increase the probability. That increases the probability that the market is overdone and going to have to rally at least for a little bit, but 24 bars is pretty extreme. Whenever extreme things happen, there's a greater tendency for much deeper pullbacks than what seems reasonable. 26, a bull bar. A lot of traders would get out a point or two above 25, or really above any bar. And 26, aggressive bulls will buy, betting on a test of the moving average, but still first bull bar in 25 bars, so probably minor. 27, another bull bar. 28, smaller bull body. Some bears, they sold the 25 high, they scaled in higher. So because of that, you know that the market's probably going to retest 25 high, which means if you're buying the 28 low, it's buying high in what could be a trading range. So if you're buying the 28 low, better if you can buy more at the 25 high, because there's bears who sold the 25 high and sold more higher. How would they sell more higher? Some bears sell the 28 high and they sell more, a measured move of the bar up. somewhere in this area. And then 29, the big bear bar went below the 28 high near the 25 close. Bulls, they bought the 28 low and more lower. So just like the bears who sold the 25 high and scaled in, you know that the bulls that bought the 28 low and bought more lower are going to make money. 30, low one short, but big sell-off, big rally, tight trading range, probably in the early stage of forming a trading range, which means probably buyers below 30 scaling in lower, and probably sellers above 30 scaling in higher. 31, trigger the low one short. Low one shorts are good sells in strong breakouts, but they're bad sells in trading ranges. And then 32, micro double bottom, down on 30, down on 29, up on 29, down on 31, up on 31. So some bulls will buy in here, but you're buying in a tight trading range. If you're taking the buy, you're betting on an endless pullback because the odds are it's going to be minor. Even if we get to the moving average, there's probably sellers not far above. 34, bad entry bar after the 33 buy. Bulls buy above 33, disappointed 34, and some of them trying to get out on the open of this bar, but it rallied into the close. And then 36 broke out above the highs of the past 5 bars. The important thing to realize here is we're trending with lows. Every low is at or above the prior low for the past 5 bars, and really the past 4 bars. So if the bulls get an upside breakout, we could easily test the midpoint of the sell-off. And then a bear bar on 36, but fairly tight channel, so there might be more buyers below, and the bears failed to trigger the buy. You can see some bears sold at 35 high. They sold more at the moving average or the high of 28. And when the market pulled back, they tried to exit back at the 35 high. At the moment, it looks like a bear leg in a trading range that's going to start to go sideways. However, in other words, it looks like a bear flag or the start of the trading range. But then you get 39 and 40, another bear bar, but very tight channel, so possibly the early stage of a small pullback trend. We have gaps, close of 35, low of 37, close of 38, low of 40. So you have to wonder if this is going to lead to an endless pullback. And then 41, another big bull bar, 42, a high one, but very tight channel. So it is a wedge, 36, 38, and 41. But whenever you get parabolic wedges in very tight channels, it increases the chances of upside breakouts because parabolic wedges in very tight channels are minor. They typically lead to a 2-legged pullback. So 1, 2, 3, maybe first leg 42, second leg here. But you can see the problem with it's hard to buy, but there's no good sells. And whenever you look at something and it doesn't look all that strong, but then you say, hey, wait a minute, everybody that's selling above bars is having a lot of trouble making money, and nobody selling below bars is making any money. That tells you that you're in a small pullback trend, and you can get small pullback trends even after strong bear trends. So you have to wonder if this is going to be an endless pullback. But even if it isn't an endless pullback, typically this is not enough to be a major reversal, which means even if we rally all the way to the midpoint, the market will often have to form a major higher low later before there can be a second leg up or reversal. 46, 47 consecutive bull bars, probably by the close, but late in a small pullback trend after a lot of selling pressure today. And then you can see we rallied further. 52, another buy climax. So a breakout 48, pause, breakout 50, pause, breakout 52. So another parabolic wedge. And 52 is breaking above a trend line. So the bulls, they have a channel from anywhere. You can argue here, breaking above it, follow through bar, probably not going all that much higher. And then 54, bears sold. They looked at 52 and 53. Bulls, they saw it and they took profits. They said, what a gift. It was hard to stay long. I got a strong bar on 52, 53. I'm going to take my profits. And the bears said, what a great place to sell. So they started selling aggressively on these bars, which is what caused 54 and 55. Now, what about selling the close of 54 or 55? I would not. When the channel up is this tight from 29 to 53, typically there's going to be buyers on any pullback. So bulls, they'll buy the close 52, they'll buy the close 53, and they'll use a wide stop and they'll buy lower, betting that a trading range is more likely than a strong bear sell-off. And because of that, it's what led to this. So strong sell-off 55, yes, but big tail. A reminder that it's probably a leg in a trading range. 56, a doji, probably sellers above, and the first reversal up's going to fail. And then the bears got a second leg down on 57. 2 legs down in what's likely a trading range. We had a bear breakout, disappointment on 56, bear breakout. What do you think is going to happen? Probably disappointment on 58. But 56 should have had buyers below. And because the bar sold off a decent amount, the bulls that bought the 56 low and more lower during 57 will likely use any bounce to get out around their first entry, and that's what happened on 58 or 59. And that's why I said earlier that break-even stops are really they're more or less dumb. If you buy below a bar like 56 and you buy more lower, if you sell below 56, you know the odds are limit order traders make money most of the time. So if you're selling the 56 low and then you get a big bar like 57, it's very common to have the market retrace the entry price only to go a little bit lower. 57, it's a sell to close bar, but it's bad context. You're selling after a very tight bull channel, and you know the odds are that we're going to go mostly sideways. You have buy the close bulls at 53 who bought and scaled in lower, and 57 is right where traders are going to start buying. It's also a 50% pullback from the low of 29 to the high of 53. So do you really want to sell right where the market's probably evolving to a trading range? Probably not. 58, bad follow through after 57. Some bears sold to close 57, disappointed 58. They will use 59 and 60 to get out around break even. 62, a strong bull bar. Is it by the close? It might be, but I suspect the channel down from 53 to 60 is tight enough that the first reversal up will probably fail, and you can see traders who sold anywhere sold more on 62. And when the market went below 62, a lot of traders started buying. 64, good bar for the bulls, but you have to ask yourself, 62 is a good bar for the bulls, and yet 63 went below 62. So 64, good bar, but not great context. Testing the high of bar 53. Let me get a sip of water. So 64, good bar for the bulls. 65, smaller bar. 66, smaller bar. And then 66 is a high one, but at the top of the trading range. Whenever you get a high one at the top of the trading range, it often leads to traders fading the bar than buying. In general, inside bars are high ones or low ones. So a bull inside bar in a bull rally is a high one. Bear inside bar in a bear sell-off is a low one. Low ones after strong breakouts like 7, 8, 9 typically lead to lower prices. High ones in tight channels, but when you look to the left, there's obvious lower highs, typically fail and lead to more sideways trading. And that's what happened on 67. 67 is a bear bar, but it's basically a micro channel since 57 if you ignore 63. And that means that the odds are the market is going to go more sideways. There we go. So anyways, tight channel, sideways, likely bulls buy the 66 close, they buy more below 66, scaling in lower. And then 68, a bull bar testing the 66 high. Some traders will use this bar to take profits. Second entry buy, but lots of 4-bar tight trading range. Not really a great buy. And then 69, another big bull bar, but a possible wedge. 58, 62, and 65, and then a bull break out of the wedge, or you can say 62, 65, and then 69. But either way, good bar for the bulls at the midpoint of the sell-off or midpoint of the day. Let's see what the next bar looks like. I mentioned that it's common for the market to go a measured move of the bar. So in other words, if this bar is, let's just say, 4 points tall, it's common for the market to go 4 points up and then sell back to the high of the bar, which is what happened here. So bears sell the high of 68, or they sell around a measured move up of 68, betting that the market will go back to the high of 68. Bulls, they bought the low of 69, they bought the retest, they scaled in lower, and a lot of those traders will get out on a bounce. Some bulls bought the close of 69, and they scaled in lower during 70. Just like the bulls who bought the 53 close scaled in lower, bulls will do the same on 69, even though it's a more dangerous place to buy and scale in. And that's what happened on 71. A lot of traders who bought the close of 69, disappointed with 70, they used 71 to get out around break even. And that's what led to a second leg down on 73. 73, is it a sell the close bar? It might be, but lots of bars above the moving average, bottom of a possible tight trading range, not really ideal. Now 74 is a bull bar closing on its high. 2 legs down, 70, 74. Okay stop entry, but whenever you have a big bear bar like 73 and then a bull bar closing on its high, 74, you always have to wonder if 74 is retesting a breakout point. Some bulls bought the 72 low and more lower on 73 or 74, and they used the rally on 74 to sell out of longs. So it's possible the high of 74 is resistance and will lead to a second leg down. Bad entry bar for the bulls that bought above 74. So some bulls, they bought above 74, disappointed 75, and some of those traders will start bailing out of their longs on the close of 75. So they buy the close of 74, they buy above it, and they're disappointed 75. Rather than their stop get hit, a lot of them will just take a small loss just in case we collapse. And that's in part what happened on 76. 76, possible wedge was 70, 74, and 76. So some bulls, they bought above 74, they'll buy more below 74, betting that the market will go more sideways. And then 77 reversed up, and the market went sideways into the close. Or stop entries, reasonable to sell below 4, but hard to do, betting on a trend from the open. I thought it was higher probability to sell below 7 or 8, and then you can sell below 10. You can sell below 15 even. You can sell below really any of these bars and use a wide stop. And then what about buying over here? What about selling below 22? I would not. Once you've had 20 bars in a row of bear bars, it starts to really lower the probability that the market's going to go a lot lower. So not really that ideal. And often, if you sell below bars like 10, you can often use a stop. Typically, the market will give you whatever you had to risk on the trade. So if you sell below 10, you could often put a stop maybe 1 times the size of the bar up, and the market will typically be able to get whatever you had to risk on that trade. Okay to buy above 33, but I would not. Tight trading range. And where did it become always in long? Over here, probably on 47, but not much left in the move. you're buying late in a rally that's probably forming the top of a trading range. So if you buy above here, probably better to get out below 54. And what about selling below 54? I would not. Bulls, they can buy 60, but really hard to do buying in a tight trading range. But the odds are we're going to test the 53 close. And that's probably it for stop entries. You know, one of the challenges with days like today is when you get a sell-off that's this strong, most of the rest of the day is going to be confusing. You know, so in other words, it's going to have a lot of limit order trading. Limit orders, probably sellers above 6, and everybody was selling closes or below bars here, so no bars triggered. Sellers above 20, but I think it's really hard to do that when you've had 20 bars in a row that are bear bars. Buyers below 28 scaling in lower, sellers above 25 scaling in higher. And probably buyers below 44, but buyers below 32. Excuse me, buyers below 32. Hard to do though with all these overlapping bars, but bears not making money above bars. And buyers scaling in lower, anywhere over here, buyers below 59, betting on a test of the 53 close. And, you know, really the rest of the day was a limit order market. For buy the close, sell the close, probably sell the close 4, 5, and 6, but hard to do. Clearly sell the close 7 or 8, 9, 10. And you can really sell any of these bars as long as you can use a wide stop. And in general, the way I look at it is whenever you're in a sell the close market, if it's going to be any good, it usually should not go above that bar, at least 1 times the size. So if you're short, it probably should not go this distance above. Bear bar probably shouldn't go up to here. Doji bar probably shouldn't go up there. And you can do the same for all the bars. And that's just a quick default way to stay in the trade. But whenever you see this and you see 12, 13, 14, I think it's really hard to stay short. And I think it's okay to exit. I mean, when's the last time you've seen 25 bars in a row that are bear bars? Certainly not common. And then probably, what about 28? 28, if anything, I think it's sell the close bar. Betting that this gap closes, probably buy the close 46, 47. Buy the close on 57. And that's probably it for buy the close, sell the close. Let me take a look at questions. Okay, question, I bought above 33 here. I've already answered that, but they bought above 33 and they couldn't stay long. And what they're asking is, how do they gain more confidence in not scalping out early? Well, I think in part it is due to, you have to understand what is the overall market cycle. So if you're buying above 33, what's your premise and why are you buying? Are you buying betting on a few legs up and bears selling around the moving average, or are you buying betting on a higher low major trend reversal? And if you buy above it, stop below 29 or 33. No reason really to get out. You can get out below 37, but it didn't trigger. And that's one benefit to getting out when bars trigger, is it'll keep you in the trade longer. You could also argue that getting out below 37 doesn't make any sense, and it's common because of the tight bull channel. Also, whenever you take a swing trade, it's common to get a bar like 37 that tries to shake you out of the trade. If you go back to the breakouts video, right before there's a breakout, the market will often do something to shake you out of a good trade and force you to chase the market up. Other than that, I think it just takes a lot of practice being willing to hold on to swing trades. And the more you understand the context, the easier it gets to hold on to trades. So question, to close the gap, does the candle body need to overlap the bar? Can the wick overlap be enough? So that brings up an interesting point. What they're asking is, if you get a high like 40 and 41 breaks above it, can 42 falling below the 40 high be enough to close the gap? I like to look at it from a more of a standpoint of how easy is it for traders to make money. Gaps are important because it helps paint the picture of counter trend traders. So if you're a bear and you sold a 40 high and you scaled in higher, you sell the high of 40, you sell more during 41, you had a chance to get out at your original entry or better on 42. But if you didn't get out on 42, you had a small window on 43. But what about 44 and 45? What if you didn't get out there? Now you're trapped. And if you sold and you didn't get out on 40, 41, or 42, you're holding a losing trade. And that will create a support level. So that is more or less what I look at. If you sold the high of 35 here, betting on a test, and maybe you sold more on the 36 close, look what happened on 37. It tested the 35 high and went higher. And then 37 broke out on 38, 39 retested the 37 high and went higher again. Compare that over here. There's clearly open gaps. If you bought anywhere, you had no way to avoid a loss, and that created a pain trade. So when I look at gaps, the other thing about negative, what you're talking about is a negative gap, where the market it'll go below a gap but not close it. So for example, here is a negative gap, the high of this bar here in these tails. But if I flip this to a line chart, you'll see where the gaps. It's clear open gaps. That's why a lot of traders pay attention to the close of bars, because you can see here there's no real gaps closing. And if you look, close of this bar, here's the close of the next bear bar. Went from here to here, so signs of strength. Okay, question. Someone's asking about how they can subscribe to the course. I'm assuming you did a free trial, but let me just, I don't know if you're in Discord, but there's a support form there. You should be able to, let me do it like this. Here's the website. You should be able to just register. So you got to create an account, obviously, here. Follow the process, read the disclaimer, and then once you submit it, it should give you a profile. Then you have to make sure you're logged in, and it'll say logged in. You should be able to go to Trading Room, and here is the instructions. When you're here, I believe you just click for details, figure out how to join, and let me just do this. So I'm logged in with my account, and I should be able to click Trading Room, see links on how to join, and here is the information. Here's a tentative calendar for May. You can click request a 2-day trial, but I'm assuming you already did that because you asked this question here. Then you just click sign up for May and follow the instructions. And you can also sign up for older webinar archives you can purchase. But anyways, I hope that answers that question. Okay, question. I can see a measured move based on the gap with the 6th. So they can see a measured move based on the gap of bar 6 basically the 6th of March high. Okay, let me reread this. So they're asking about the daily chart. Okay, question. I can see a measure move based on the gap with the March 6th high here. But on the ES, the gap has either closed or is a negative gap. Is the measure move still valid? And can you talk about the difference between cash index charts and the ES? Yeah, I think that most traders, for me, can you argue? For me, I see this gap is closed. Let's just say, here's the close of March the 6th. April 26th closed far below it. And this is the more important gap, the March 13th low to the March 22nd high. We tested it, and we're trying to decide what to do here. I thought the bulls had a chance yesterday to get up to here, and clearly they're not doing so great. So to me, this increases the chances of more sideways back into this area. You can see we went back down to 4,100, so we're back in this tight trading range. As far as cash index or ES, Globex, I treat it all the same. So for me, if I'm looking at a chart, let me just do it like this. I try and keep it simple. So here is the cash index. Here's a monthly chart of the cash index. Let me just do it like this actually. Here is the current cash index. When I look at this, you can see on this chart, we pretty much closed this breakout point. And for me, it's the same thing. This low to this high takes you somewhere up here. And the bears, they had a bad stop entry buy here on April 26th. Bears sold above it, scaled in, getting out break even. So I view it all as the same. But I hope that answers your question. Gaps and breakouts, it's irrelevant. Why do I look at the day session instead of the Globex a lot? For me, it's just preference. Al did that all the time. I watched Al do it, and I like the concept of there being 81 bars to the day. So that's my preference. But you can look at the Globex. It doesn't matter what you look at. Someone said they learned a lot today and they were profitable today. That's always good to hear. Okay, question, could you explain context when 3 consecutive bars, why 3 consecutive bars are important and why they're not? It has to do with the market cycle. So really what that comes down to is, what is the market cycle? 7, 8, and 9, even if you get 3 consecutive bars against it, who's going to sell or who's going to buy? Nobody. So clearly going lower. Even bars like 26, 27, 28, closing above a lot of bars to the left, had a very deep pullback before there was a second leg, and the market was extended. Compare that to yesterday. Bar 1, 2, 3, and 4. 3 decent bear bars, or 3 decent bull bars, 1 doji. Still very deep pullback. But then here, 3 bear bars, 1, 2, 3, reversed basically to the low of the day. So why did 21 sell off here? Well, we had 2 legs up and a lot of trading range price action. So rally, bears making money below bars all through here. Second leg up, very deep pullback. Strong rally here. Even with 2 bear bars, the market had to go sideways for 10 or 15 bars before the bears got the downside breakout. So it has to do with the overall market cycle. The more obvious the market's in a trading range, the faster traders get out. Great example is the daily chart. Great looking bull bars, but possible expanding triangle. here, and here. And because of that, we know from the get-go that, yes, it's a great looking breakout, but it's within a trading range. And if it's within a trading range, we know the odds are the market could have a very deep pullback, if not reverse. So to me, traders are faster. Same thing here, strong bear breakout, but then 4 decent sized bull bars, traders started giving up and we led to a rally. Now, how could we reverse like this? Well, if we look at it, 22 sold off and had a deep pullback to the 23 high. So it's in essence a double bottom. We went down on 22, up on 23, down on 24, reversed up. So it's a major trend reversal on a smaller time frame and within an expanding triangle. The stronger the breakout, the more will be required to reverse it. We didn't have any short covering today. Does that mean more up tomorrow? Well, we arguably reversed up. That was a question someone asked. But we arguably reversed up a fairly decent amount today. So strong sell climax. There was short covering. And in fact, look where the short covering was. So the high of March 26th is 41.09. And you can see we went about 3 points below the high of April 26th, excuse me. We went about 3 points below it here and reversed up. So it was a sell vacuum. Okay, question, how are probabilities changing from 10 on or, okay, so you're asking about the Excel spreadsheet. So how would you describe the probabilities? I'm just changing up the wording to the question, but they're asking how were probabilities changing from bar 10 on in the Excel spreadsheet. Yeah, what they're talking about is this right here. The spreadsheet that I often use when I'm in the room. And it's just there's nothing really to it. It's just a formula that explains the trader's equation. Okay, so here is one of the tables. And if we think about it, really the way I look at it is if I'm selling below 7, stop above 7, I may have let's just say I'm going for 1-to-1. And let's say my probability, I think it's 60%, but let's say it's 55%. Who cares? The reality is, if this trade's going to work, I'm probably going to get better than 1 times my risk. So my actual risk might be very small. Also, I've got a reasonable shot at getting twice my risk. So maybe from here to here, twice my risk might be down here. So if my risk is 1, maybe I go for 2. And I might have a 55% chance. Either way, the point is, what's more important to realize here is when you see 7, 8, 9, the probability overwhelmingly favors the bears. So it's sell the close for any reason. At some point, like 10, like 18, 19, 20, anywhere in here, the probability favors a pullback. And eventually, if you're selling below, an easy example is down here. If you're selling below 22, what's the probability? If you sell 22, what's the probability that the market gets to the 22 high before it goes 1 times your risk? And to me, it's getting to be a lot closer than 50-50. And eventually, it starts to shift. What's the probability that the market goes from the close of 25 all the way down here, your target, before it goes to the high of 22? And it becomes close to 50-50, and then it shifts the opposite direction, and then the market reverses. Same thing here. What's the probability if you buy the 26 close, stop below 25, what's the probability the market goes to 1 times your risk before it stops you out? Well, it may not go to 1 times your initial. It's not really a great trade. But if it goes straight up, your actual risk could be very small, like 27, 28. But the problem becomes here. Here's the 28 close. Let's say you put a stop below 26. If you put a stop below 26 here, and you buy here, 1 times your risk is extremely far away, and that increases the chances that the market may do the opposite and have a very deep pullback. If you're short here, let's say you sell below 30, stop somewhere up here. So you sell 28 high, stop below 30, target down here. If you're short anywhere, selling here, stop up here, target here. It's really bad risk reward, and the probabilities arguably 50-50. Therefore, you can't take that trade. When you see 32, 33, stop below 33. You have small risk, probabilities low, but we could get a rally lasting a couple hours. And obviously, if you bought above 33, stop below, and held, you would have achieved several times your risk. So question, they bought bar 29 here. So I guess they bought 29 on the test of the EMA. Okay, I misread that. So they bought bar 29 at 25 here for a test of the EMA. Ready to add on. Was that where it be a reasonable stop? Yeah, this is always a great example. So what this person did is they looked at the rally up to 28 and they expected a second leg up and tested the moving average, and they ended up buying around the 25 high. I think that's a very good location to buy. You know the bears sold the 25 high, scaled and higher. You know that's a target for the bears. So a lot of bears bought here, bulls bought, and where do they put their stop? Common logic would tell you to put it below 25. But the problem with putting a stop below 25 is what happens if the market falls below 25. You don't want to put a stop right where traders are going to buy more. So if you look at 25 and you think, yeah, if the market falls to 25, I want to be a buyer, then that's the worst place you could put a stop. So most traders better off putting a stop a couple of points below bar 25 at a minimum, maybe 5 points below, 10 points below, which makes it a very difficult trade. And you basically have to be able to get out beforehand. Other way to look at it is I'm going to buy this breakout point and maybe something like this. So if my target's up here, I'm going to buy here, put a stop somewhere down here. And if we get consecutive strong bear bars below me, I can exit. Other traders, when you see this strong of a sell-off, testing bar 25, a lot of traders will scalp out. So they'll buy the 25 high and sell on a bounce because they think the sell-off from the 28 high to the low of 29 is strong enough to lead to a small second leg down. And if their odds favor a small second leg down, it doesn't make sense to be long. And then they start to buy again in here. So some traders, they see three bear bars, they wait for a bull bar, and they try and buy a pullback, betting that this bar is strong enough, 33 or 32, that bulls will buy below it. Question, is it fair to say that line charts with gaps are used by traders to assess whether to enter a trade in the direction of the gap? Is it fair to say that line charts with gaps are used by traders to assess whether to enter a trade in the direction of the gap? Question mark. It may not mean that the opposite side is still trapped, right? Try and give examples. Whenever you have a longer question and it's a little vague, try and have an example, because it's hard to it's easy to misread what the person's asking. But anyways, so if you have a line chart, I'm just going to pull up a line chart. So here's a chart, and here's a line chart. It's a 5-minute chart of today. And this question is it fair to say that line charts with gaps are used by traders to assess whether to enter a trade in the direction of the gap? Yeah, so a gap's a sign of strength. So obviously, if price went from here to here in the close of a couple of bars, or from here to here in the span of 10 minutes, then that increases the odds of lower prices. And that is no different than looking at it from this, here to here. That's a lot of distance in 15 minutes. It's probably going to go lower. You can do the same thing with an open, high, low, close chart. We gapped. We're going down, not really any deep pullbacks, and selling off. So I hope that answers that question. Okay, question. If you sell the close of a bar like 69, you sell the close of a bar like 69 here, betting on a failed bull breakout, what's a reasonable wide stop and target? One is, there's two ways. I think an easy one is sell the close at 69. You're basically selling a measured move up of the bar. So if I was going to do that, one way I would do that is something like this. So for me, if I'm selling the close, and let's say I'm selling the close and the high of this bar is 4 points away, it's reasonable to assume that the trade should not go another 4 points against me. So if I'm taking that, I might try and get 1 times my risk. Or I could look at it like this. Here's the low, here's the high. I'm selling this high. Probably shouldn't go up to here before it goes down to there. I think the challenge people face themselves with is they sell above a bar like 36 or 37 during 38, and they use a really wide stop, and they just can't manage to get out, and then they scale in, and they get killed. So you have to have a simple way to get out. Okay, last question for today. I wanted to get your thoughts on yesterday's price action, bar 62. Let me go to it. So they said bar 62 was a double bottom with bar 24. Yes, 24 low, 62 low. It's a double bottom. Okay, more of the question. And Al mentions sometimes second legs of double bottoms is a sell climax. So in other words, here's a sell-off, rally, second leg down is a sell climax, 61, testing 24. Was it reasonable to buy above 63 for a scalp up to the high of 61? Okay, so was it reasonable to buy on the above 62 or the close of 63, betting on a test of 61, and at least look to close the gap below 60? Because trading range days, gaps close. Yeah, so for me, 61 is a second leg trap. We sell off, we have a wedge, 40, 50, 60, bear breakout. It's a second leg down. Therefore, it's a second leg trap. And when you look at 61, though, it's a big bar, and it's a fairly strong bar, which means it's probably going to have a second leg down. Therefore, the pullback is it's a trading range, yes, so the pullback will probably be deeper than what bulls want, than what bears want, but unless the bulls can get something like this, 24, 25, 26, 27, probably going to get more sideways. Sorry about that. But anyways, unless the bulls can get this over here, probably more sideways, The other thing, little nuance, is 22. It's a big bear bar, and it led to a second leg down. 22 is a big tail and a rally on 23. So it's basically a double bottom. Here, it's a sell-off, probably going to get a second leg down. For me, whenever you see a big bar, it's generally, you have to assume that there's going to be some reasonable attempt at a second leg, and for the market to at least go below 62. All right, so where do we go tomorrow? It'll be interesting to see, but I suspect bulls are disappointed enough by today's bar that there's probably sellers above for a second leg down. But just like the bears made money selling this high, I suspect the bulls will make money buying this low. But we will see. Let me just check one thing really quick.